Here in New York City, I'm Brad Smith alongside Brian Sazi this morning. This is Yahoo Finance's flagship show, The Morning Brief.
All right, huge week on tap for markets, and stock futures are in the green following last week's big tech rout. For now, a slew of corporate earnings from tech giants like Apple and Microsoft, and a Fed decision will test the mindset of more jittery investors over the next 5 trading sessions. So let's get after it. Here are the 3 things you need to know this Monday morning. Yahoo Finance's Jared Blickery, Brooke DePalma, and Josh Lipton have all the details.
Investors preparing for a busy week with big tech earnings and a Fed decision on deck. Apple, Amazon, Microsoft, and Meta are expected to drive the market's direction to start the new trading month. Now, traders are looking for further evidence that AI is all that it's cracked up to be after earnings from Alphabet and Tesla led to a slump in big tech stocks last week. The S&P 500 and Nasdaq Composite recently had their worst single-day drops since 2022.
Plus, McDonald's is dealing with a more cautious consumer. Second quarter earnings fell short of Wall Street expectations. Global comparable sales falling 1% in the last year as consumers tighten their wallets once again on Big Macs. Recently, fast food chains have been hyper-focused on attracting consumers by introducing the flurry of limited-time value deals. McDonald's recently announced plans to extend its $5 meal deal through August in hopes to regain its dominance as a value player after increasing prices in recent years due to inflationary pressures.
And crypto is surging with Bitcoin hitting a 6-week high, pushing towards 70,000. Price of Bitcoin is moving higher after former President Donald Trump solidified his support for the asset in front of thousands of crypto enthusiasts at a Bitcoin convention over the weekend. Despite once calling Bitcoin a scam back in 2021, Trump has changed his tune, saying to never sell your Bitcoin.
It is Monday, July 29th, so let's get you set up for a very, very busy, I mean, it's going to be fruitful one way or another. Yeah. Busy trading week ahead. Here's what you need to know as we're taking a look at some of the big earnings on deck this week. Of course, you're going to get a mix of all those household names. We've really got tech. We've got everything in the accommodations with Marriott lined up for you, and even more tech with Meta, one of the outperformers over the course of this year. And then additionally, you've got some big energy sector plays. Since I mentioned energy just very briefly here, I know it's not the sexiest thing to start the show on, but let's go to the oil and gas sector here, because that's where we're going to end things later on this week with Chevron and Exxon in the energy sector. As FactSet has said, going to be in focus despite a 9.7% year-over-year increase in the average price of oil in Q2 2024. The energy sector is reporting the 3rd largest year-over-year earnings decline of all 11 sectors in the S&P 500 thus far in the earnings season.
Hey, it's sexy to me, Brad. I just paid $4 a gallon for some gas for my sports car, man. I mean, I want to hear what Chevron and Exxon have to say. But to that end, it's not all about earnings season madness this week. We've got a busy week for central banks. A Federal Reserve rate decision is due Wednesday with hopes the Fed signals a September rate cut. The Fed's counterparts in Tokyo and London are also meeting this week. And we will get a look into how the economy is faring with the big jobs report on Friday, which comes at a time of souring economic data on the consumer. This is a busy, busy week, Brad. I think the most important thing, of course, is that Fed meeting. Does the Fed come out here and tee up that September rate cut? Even if they don't, Brad, they may have time to do that at the Jackson Hole event in late August. So I'm watching that, but also really watching the jobs report. We've seen some weakness in consumer land here. A lot of companies call it out. Just this morning alone, Heineken called out consumer weakness. I need to know what's happening in this jobs market to see if the consumer will bounce into the back half of the year.
Yeah, it's not that this meeting this week is going to be a dud, but it does have some dud elements to it, especially when you look at the CME Fed Watch probability coming into this meeting, largely expected to hold rates steady and at the same level here. And then, as you were mentioning, Saz, all eyes really shift towards September and what that probability as of right now is looking like for a cut, and how the Fed kind of inches themselves, at least in their commentary, closer to that potential cut in September.
Yeah, maybe a rate cut will help the business of hamburgers. Speaking of that, the McMiss, quarter pounder seller McDonald's, lays an egg versus street estimates for sales, same-store sales, and profits. The company's CEO, Chris Kempczynski, is out warning that consumers are, quote, more discriminating with their spend. Yahoo Finance senior reporter Brooke DePalma has the analysis for this one. Brooke, I know you've been on that earnings call dissecting the numbers. What are some of the takeaways here?
Yeah, good morning. Well, first note that this is the first global same-store sales decline since Q4 of 2020 when restaurants were forced to close due to the COVID-19 pandemic. And this really speaks volumes to consumers pulling back on dining out at America's most dominant fast food player. Taking a closer look at the different segments in the U.S., same-store sales decreased 0.7%. That was driven by a drop in guest counts, a drop in foot traffic, that is. And this was the first decline in the U.S. in 16 quarters. Speaking volumes to the state of the U.S. consumer right now. Internationally owned locations saw a 1.1% decline caused by negative sales growth across a number of markets, driven lower by France. And international franchise locations saw same-store sales drop 1.3% year over year due to that ongoing impact of the war in the Middle East, as well as declining same-store sales growth in China. And on the call right now, executives are weighing in how exactly they're going to turn around these flagging sales. We're hearing from executives that they're working to earn back customers after raising prices in recent years due to those inflationary pressures and disrupting long-running value programs. CEO Chris Kempczinski saying on the call, consumers still recognize us as the value leader versus our key competitors, but it's clear that our value leadership gap has recently shrunk. We are working to fix that with pace. And it's important to note here that McDonald's did extend that $5 meal deal that they introduced at the end of Q2 on June 25th until August. And so many investors on the street hoping that this benefits the fast food giant.
I mean, what are analysts saying right now, does it seem, about this broader plan? Because the executive team this morning, at least, doubling down on their plan to accelerate the arches, as they call it, which comes back to some of the marketing. Sazi's snickering right now.
Accelerate the arches.
Accelerate the arches.
Their major growth
Make a
strategy
better
they
burger,
introduced a few years
Make
ago.
a better burger.
Well, they do have that better burger coming out. It's hitting all markets. It's a little bit of a revamp, but really analysts
Pat
saying...
LaFrida beef in that one?
Look
Analysts here...
at the sizzling analysis.
Exactly. It's hot. It's hot right now, Saz, but really investors right now thinking that this is near term, going to be flagging sales, ongoing flagging sales, but value, really the hope that this is going to turn things around here.
You don't get excited about the 4Ds and this accelerating the arches plan? Delivery, digital, drive-through,
Brad knows where it's at.
No, I'm worried about McDonald's here. The fact they're not unable, I think, to get positive traffic through their door at a time where prices are starting to come down. I'm concerned about this company. I really am.
And this value deal is really, of course, trending well with low-income consumers, and that's what every fast food player right now is trying to chase. They're trying to get that low-income consumer back in the door, as they're really not even competing entirely with just fast food. They're competing with the grocery store now, as they really look to hit that right price point.
Full disclosure, I love Taco Bell. I love those tacos.
Have you tried the Lux
get it
meal?
out there. Look, that doesn't prevent me from providing unbiased reporting, but I love me a good taco from Taco Bell.
All right. Good to know. I know where I'm getting your lunch today. Thanks so much, Brooke. Appreciate it. Big earnings week ahead, everyone. 171 S&P 500 companies are scheduled to report results for the second quarter, according to FactSet. Now, with results from some of the biggest tech names set to report, can results bring the spark back into the tech trade? To discuss, let's bring in, here in studio live and live in color, Marvin Lowe, who is the State Street Senior Global Macro Strategist here. Marvin, great to see you here.
Morning. Nice to see you also.
Absolutely. So let's dive in here. I mean, the S&P 500, since we mentioned FactSet and some of them into the chat here, they had also mentioned that the S&P 500 is reporting net profit margin above 12% for the second time since the second quarter of 2022 here. You got 171 S&P 500 companies reporting this week. What is kind of the make or break point that we could see play out over the course of the next few trading sessions?
Certainly kind of this tech trade, if you will, and then the subsequent rotation out of it over the last several weeks is a significant kind of macro driver out there. We're near correction territory when it comes to the Nasdaq at this point. And we'll see whether or not kind of this adjustment needs a little bit more room to go, or whether or not it's adjusted enough. So it is important, particularly given just the weight that the companies who are reporting this week make within that broader index.
Buy or sell tech stocks here?
I still like tech stocks. To me, the fundamental reason why you own them hasn't changed that much. There's a reason that these companies exist within the United States. There's a reason that there's U.S. exceptionalism around it. And I don't think any of that has really changed. Valuation, certainly. And we all were concerned about how frothy everything got over the last month or so.
But it still seems frothy. I was talking to the folks over at Citi this morning on my Opening a Bid podcast, and they're pointing out valuations 30, 40 times for a lot of these AI companies. That's a significant market multiple, even after the correction. I mean, so how can you even buy these names?
You know what? I mean, you're talking about growth models which really will take a significant amount of time to come to fruition. And it is always the companies that you pick rather than a broad sector. There is a lot of strength in those markets. And there are two sides to that coin. So certainly there's been a lot of spending on AI and it hasn't necessarily resulted in immediate revenues. But that spending on AI is going someplace also. So there are two sides of that coin. And I think we need to think through that whole value chain.
But it's a near-term margin hit as well for the spending on AI at this juncture.
Yeah.
So how much does that continue to really be a weight on what we're seeing in forecasts from companies, especially the big tech companies? We've got Meta on deck this week. You've also got Microsoft, all of these that have already said, all right, our big quarter was really behind us, or at least seems to be behind us right now towards our AI spend, but then the market is waiting for us for it to show up in the revenue.
For sure. And when 12% revenue, when 12% year-over-year growth rates are not enough, it tells you that valuations certainly were starting to price in perfection, and there's going to be volatility around that. A lot of these, more companies are meeting than average. It's still not kind of driving any upward feeling, if you will, in terms of expanding multiples. Kind of having said that, these are still relatively strong earnings numbers that are coming out.
We've seen weakening consumer confidence. I think earnings growth has been starting to slow for many companies. Why isn't this mini correction the start of something worse? Why can't it be the start of a bear market?
I think the economy is still solid at this point. Certainly recession concerns are increasing, but we got GDP growth, which is still well above trend. We've got that GDP being driven by personal consumption. That's a real positive. And the employment market is incredibly important. We've got so much data to parse through this week. But if we're still adding somewhere close to 200,000 jobs a month, that's very accretive to the economy.
What do you think the theme is that wins out this earnings season, the prevailing or common denominator that we begin to hear from most companies?
Yeah, I mean, certainly we're getting to a point where the low-hanging fruit is done, particularly with the consumer side of things, and we're starting to see a bifurcated consumer. I think what we really need to parse through is, and it's unfortunate, there are a lot of tapped consumers out there. The savings that we had gathered over the course of the last couple of years, I'm pretty comfortable saying is done, but there still is a lot of wealth in this economy, and we need to kind of figure out if those pools of wealth can continue to support overall spending in the economy.
We tried hard not to ask about McDonald's. I think it says a lot about the economy that people can't go out there and spend $5 for a hamburger.
No, for sure. We are seeing a bifurcated economy, and even within those restaurant releases, you're seeing different performances based on kind of income strata, and that is getting worse.
So you had to squeeze that in. Marvin Lowe, State Street Senior Global Macro Strategist. Good to see you. We'll talk to you soon.
Thank you.
All right, Bitcoin is hanging out near a 6-week high. This after former President Donald Trump sounding bullish on the commodity at the annual Bitcoin conference. He stopped short of promising to establish a strategic reserve for Bitcoin, but did double down on maintaining the current level of Bitcoin holdings the U.S. has.
The federal government has almost 210,000 Bitcoin, or 1% of the total supply that will ever exist. But for too long, our government has violated the cardinal rule that every Bitcoiner knows by heart: never sell your Bitcoin.
And former President Trump having some choice words for SEC Chair Gary Gensler. Take a listen.
On day one, I will fire Gary Gensler. I will appoint a new SEC chairman who believes America should build the future, not block the future, which is what they're doing.
Brad, where do you want to go with this? You're the Bitcoin expert here on this desk.
Yeah, so I'm going to lead in with the Bitcoin side. And I had a few friends that were actually at this conference, and over the past few days had seen everything from Make Bitcoin Great Again hats all the way down to pins that were circulating and saying vote for Bitcoin. I think for a lot of the movement that we've seen, and let's not forget, there was a larger kind of cryptocurrency crackdown that did take place under the first Trump administration, whether that was looking across ICOs and making sure that everyone from Floyd Mayweather down to some of the other major influencers that were launching their own coins, that they were fined and that they ultimately did have to kind of disclose what their involvement was. And then now even into the current Biden administration, where there's been more of, I think, this similar crackdown, but quest for transparency among a lot of the crypto barons, if you will, and trying to make sure that it's not an industry that continues to be upheld, or at least their core figures that become the poster children. And a lot of those poster children have essentially been eradicated now and are either serving or getting some type of sentencing one way or another. For Gary Gensler, I think he has been in the position where he has had to be a part of this crackdown in order for there to, on the other side, be ETFs that are able to be vetted. And yeah, that takes years of time. It's not, one just fast track this straight into somebody's portfolio. But at the end of the day, that vetting allows for some of the next inflection points that we had seen, like the one that we saw in Bitcoin, once the 11 ETFs, the original ETFs, were approved for Bitcoin. And then now all the focus is going towards Ether. And so it's really just looking across some of the verifiable and validated cryptocurrencies out there and saying, okay, what's next on the docket so that the American investor and the international investor is not getting burned when, and especially after some of the events of 2022, thinking back to FTX, of course.
Yeah, interesting note in my box from the folks over at Bernstein. They're suggesting now we might see a reset within the Harris campaign towards cryptocurrency. So that might be one of the next catalysts to watch.
It could be, easily. I don't know. That's no doubt, Bitcoin's gonna make its way to the podium if there is another debate. I think.
Well, I'm gonna put that question to one of our guests in the 10 o'clock hour. Tune in. In that 10 o'clock hour, we'll be talking to influential crypto investor Anthony Pompliano of Professional Capital Management. He's the CEO there, to get a sense on the next big moment for all things crypto.
All right, can't wait for that conversation. We're just getting started here on the Morning Brief, though. Coming up, shares of Alibaba. They're in the green to start the week. The company reportedly going to raise merchant fees. We've got the details and more trending tickers right after the break. Plus, bullish on Apple. Why one analyst thinks AI is the key catalyst to support lackluster iPhone demand. He makes his case later on in the show, and later on, as we mentioned, Trump becomes a Bitcoin bull, but isn't enough to sway investors. Longtime crypto bull Anthony Pompliano going to join us in Catalyst. Going to decode the former president's message to the bulls. All that and more on Yahoo Finance.
Busy day.
Alibaba shares moving higher after reportedly telling merchants it will begin charging a basic software service fee. This is according to Bloomberg, and the company may plan to waive the fee for smaller merchants. That's also according to the report here. Taking a look at Alibaba shares right now, they're up by about 2.4%. Sazi's shrugging. Why does this matter? I mean, this is where they make most of their revenue. That's why this matters.
Remember when Alibaba was like one of these hottest stocks in the market? I mean, this stock, look at that chart. This stock has done absolutely nothing, and I'll tell you why. It is because the Chinese economy continues to surprise the downside. We're hearing that from the likes of a Heineken this morning. We'll talk about that in a second. But a lot of companies reporting major China weakness. I think it's catching a lot of investors off guard, and you have to wonder, even though Alibaba shares have come down considerably over the past few years, if there's more downside risk to this name.
I mean, and let's remember, we were just talking about Alibaba this time last year, it seems like, on the verge of being a broken up company into 6 different entities, remember? And so now we're looking at an Alibaba that is pressured by the Chinese consumer, that's also facing increasing competition, especially in the cloud landscape right now, by a lot of U.S. incumbents that are trying to move more into the Eastern Hemisphere, trying to make sure that they can also shore up some of their international growth there on the cloud and web services division, if you will. So kind of getting hit on both sides, the most highly profitable side, and then additionally now seeming to reach further into the merchants on that consumer side to try and drum up more revenue from them, where it is lagging on the consumer side, as you mentioned.
Look, if one is hell-bent to play internet e-commerce, just read the annual report for Amazon or Walmart. I think that'll get the job done. All right, switching gears here. Abbott shares looking unhealthy after a jury ordered the company to pay $495 million in compensation and damages, saying it did not warn consumers its formula used for premature infants raises the risk of bowel disease. Yahoo Finance senior healthcare reporter Anjali Kamani has more analysis. Anjali.
Yeah, that's right. It's important to remember, first of all, that this is unrelated to the issue that Abbott had with its formula with its Michigan plant. We remember that whole episode, but this is unrelated, and it is an ongoing case from 2021. We've seen that the company has had a number of lawsuits filed against it, as well as competitor Reckitt Benckiser. So this is a second lawsuit in this broader look at NEC, necrotizing enterocolitis, which is the disease that has the fatal disease that some of these babies have been received from the formula. So the first lawsuit was actually $60 million, and that was in a different court in March. This new one is much higher, and that's why a lot of investors are watching it. $400 million of that is the punitive damages, and that's the one that can also move a little bit more depending on how a judge feels like, according to the results. So the jury came out with this number. Judge still has to go through. We know that Abbott is, of course, going to be appealing it, just as Reckitt has for its in the past. Now, to point out what the investors are looking at, what analysts are looking at, JPM said in a note that following precedent from similar matters with talc, Respironics, and opioids, we think the per settlement amount could fall into the 150 to 300K range, translating to a total settlement of up to $1.5 billion as more cases are filed. You have to remember 1,000 cases have been filed against these two companies. So it really is something to watch. This area of Abbott's business continues to be a problem for them, continues to have this overhang of this case as well as the prior issues. And so that's definitely something to watch despite any positive results from earnings.
All right, we'll continue to keep an eye on shares going into the opening bell here. Anjali, thanks so much. Appreciate it. We've also been tracking Heineken shares slipping this morning after its first half profit came in below expectations. The company's beer sales also falling short of estimates, growing just over 2%, missing expectations rather of 3.7% here. Shares right now down by about 8.5%, a little more than 8.5%, as investors sour a bit on the beer name here. You were slacking me at 4 a.m. about this story this morning.
I was, because I do think this is not, I was actually, wow, I don't know where timing's gone, but this is probably, I think, one of the most important stories in the market today. Sure, we have to talk about the Fed, Bitcoin, all that stuff. But to hear Heineken come out and say they're taking a large write-down on their China business, I think that says lots of negative things or sets the tone for results out of, let's say, a Starbucks. I think it validates what we heard from General Motors last week, where their China results basically fell off the map. That is a big, big red flag. But then, of course, too, if you want to do direct comparisons, this is not necessarily a great sign for Anheuser-Busch, which, of course, is a global company. But it may not even be good for a company like a Procter & Gamble that reports tomorrow, and they have a significant China business, too. So overall, I just think this is an important report, Brad.
I think
It is
also,
worth the 4 a.m. message.
Well, yes, it was worth the 4 a.m. message. I think that it also comes back to some of the changing consumer profiles and tastes. And, I'm not going to blame Gen Z, but I think that there is a large, more outsized impact that Gen Z is starting to have on some of these beer businesses and how they have to think about really selling into that core consumer group and cohort as tastes change over time. And as we've seen over the course of time, they certainly are having more of a look at alcohol, wine, spirits, and trying to figure out, okay, where they would like more non-alcoholic options. And that's where you see some of the newer companies that are saying, okay, 0% alcohol, fine. We'll come up with something that tastes analogous to what you're already having. And some of the traditional beer, trad beer, if you will. I don't know if that's a thing yet, but perhaps after this segment it will be. If that gets legs, then trad beer could be in trouble.
Brad, you're the coolest guy in this office. What do you drink on the weekend?
I would say I'm not the coolest guy, but on the weekend I drink a lot of water.
Well, that says, right, and that says a lot about that says a lot about Heineken. Well, I'm drinking high noons and neutrals from Anheuser-Busch, and I think that says a lot. Hard seltzers continue to be a thing, and I think that says a lot about this Heineken report. Nonetheless,
I'm already getting pushback right now that I drink a lot of water on weekends by people who have spent some time with me on weekends.
I hear you. All right, well, tweet us that. All right, we'll be right back with more craveable markets analysis. Yes, craveable. You're watching Morning Brief.
All right, we're just a few seconds away from the opening bell. Brad Smith, Brian Sazi, Yahoo Finance is what you're watching here, and we've got a countdown here for you as we're taking a look at some of the major averages going into the start of today's trading activity. Futures at least pointing higher at this juncture in time. We're taking a look at the Dow, the S&P 500, and the Nasdaq, just fractional gains. Big earnings week, big economic data week.
I encourage everyone, go to yahoofinance.com.
They're on it right now.
Well, of course they are, but go to the upper left rel. And I think that's one of the stories of the morning, besides what I've been talking about all morning with that Heineken miss. McDonald's earnings miss across the board. That is our story from senior reporter Brooke DePalma. The fact, Brad, that people are not out there buying cheap hamburgers, I think says a lot about where this economy is, and I think it really suggests some downside risk to the economy that this market is not pricing in.
I think we have more questions about cheap hamburgers and what actually the hamburger is.
Maybe the food just sucks. Maybe that's just the reality of it all.
Could be. Well, that's why they're introducing new burgers. Everyone, that's the opening bell on Wall Street and in Midtown Manhattan, where you've got fake Minnie and Mickey Mouses floating around. Inside the building at the Nasdaq, though, you've got Alaris ringing the opening bell. Some funfetti there. Don't act like they're real.
They are, but they're real to me, Brad. They're all real. Even the Transformers people walking around Times Square, they're real to me as well.
Kane Anderson, it looks like, ringing the opening bell at the NYSE. All right, we've kicked off things here today live as we're taking a look at the NYSE. A lot of great, hugs all around. Why not? All right, so as the trading session is kicked off here, let's take a look at the major averages. All right, just as we suspected, open to the upside here. Nasdaq, positive territory, 1% in gains there. It looks like things might be calibrating there as we're taking a look at the Nasdaq. It was just fractional gains as we were going into the opening bell. But the S&P 500, that holding on to gains. The Dow also holding on to gains going into the opening cross.
A lot better than defibrillating. Let's get to Yahoo Finance's Jared Blickery for a look at what's moving here in the early going. Jared, take it away.
That's right. We got some green to talk about, and nice to see. By the way, this is going to be the fifth straight week of gains for the Dow, which is up an additional 52 points right now. But it will be the Nasdaq snapping a 2-week losing streak. You can see it's up about 44 basis points this morning. I think it's worth highlighting this divergence that we've seen recently. We've seen a rush into small cap stocks. Let me put a year-to-date comparison of the Russell 2000 versus the Nasdaq 100, the little guys versus the big guys. And you can see right around May, June, that's when we had this divergence. That's when we saw the Nasdaq 100 really taking off, but the Russell 2000 was flat until very recently, and now it's caught up a little bit. So we kind of have this rotation where things go in one area and then they shift to other areas. That is the lifeblood of a bull market. You hope that continues. You hope that things don't sell off everything at once, because that's when the carnage comes. And we did have a couple of days like that recently, so don't count that out. Now, in terms of sector action today, I'm tracking consumer discretionary, tech, and communication services. The mega cap sectors, those are leading, and let's take a quick look at that. Tech really surging into the forefront today. You can see as far as consumer discretionary, that's what Tesla is qualified as or classified as. That's up 3.5%. And then I just want to end on crypto here real quick. We've got a chance for a Bitcoin quote. Market seemed to like Trump's speech on Saturday at the Bitcoin 2024 conference. And we can see just right around 70,000. The record, 73,000. So got a little ways to go, guys.
Indeed we do. Jared Blickery, thanks so much. Appreciate it. All right, crude oil prices are flat after initially spiking following an attack on Israel by an Iran-backed proxy group, inflaming fears of a wider conflict in the Middle East. To discuss, Bob Iaccino, Path Trading Partners co-founder and chief market strategist here. Bob, what's your latest take on the move in the oil markets, and what's the next trade?
Well, I think initially from the fundamental perspective, the move is correct because we have seen reduced demand, especially out of China. And that's one of the bigger concerns for the market in a commodity like crude oil. Copper would be another representative of that. The recent moves that we've seen in that particular industrial metal has a lot to do with China's weakness. When the People's Bank of China actually cut rates in a surprise to the market last week, it drove a lot of those sort of longer term holds out of both assets, both crude and copper. Now, on the other hand, we do have a meeting coming up. It's not a formal meeting, but August 1st, OPEC and OPEC Plus will meet to sort of reassess the production cuts and whether they've done what they were supposed to do. And when you look at the last comments, or I should say the comments right after the last meeting in June from OPEC, from the Saudi oil minister, he basically said that the market doesn't understand what we were saying here and prices will soon rise. I'm paraphrasing. But he essentially said that while the markets interpreted that as sort of an open window to an increase in production sometime in the future. They didn't see it that way at all. So unlike normal times, you usually get a leak from OPEC from somebody at some point as to what the direction or decision is going to be. We haven't seen that yet, but they could actually deliver an August surprise in terms of more production cuts. It's possible.
Bob, great to see you here this morning. You know, I mentioned this stat from FactSet earlier in the show, and I'll mention it here to you and get your thoughts on it. As FactSet had said, despite this 9.7% year-over-year increase in the average price of oil during the second quarter of 2024 relative to second quarter of 2023, energy sector seeing the third largest earnings decline of all 11 sectors in the S&P 500 right now. What does that set up for some of the energy companies that are expected to report later on this week, and what do they need to tell to the street, to the analysts that are going to be listening in?
Well, one of the things that we need to look at, especially in the domestic oil patch, is that should do really well from an earnings perspective, because while prices are lower, their break-evens through technology have continued to move ever so slightly lower, and the oil they're getting out of the ground has been cheaper, yes, but the demand here in the U.S. has not been weak. So when you're looking more at domestic energy companies, you might see a surprise. The more integrated global companies, that could suffer because, again, of their operations overseas. But I would remind people, if you believe that the economy is not slowing as much as some people think at this point, then you're a believer in the reflation narrative, which I still am a believer in. And one of the best performing sectors over the long term during reflation narratives, which is, of course, a growing economy and a little bit stronger inflation than the Fed would like to see, that would be energy. It's one of the best performing sectors. So it could actually be an opportunity from a stock perspective, especially if we get sort of fair to Midland, for lack of a better phrase, earnings, Brad, then you could actually have a buying opportunity in energy.
Bob, if Vice President Harris continues to close that gap in the presidential race against former President Trump, how bearish would that be for oil stocks?
It would be pretty bearish. I mean, she came out when she was running for president in 2016, or was it 2020? I get so confused with these election cycles now. I believe it was 2020. But she actually flat out stated, I'm against fracking. And one of the things we're seeing in the U.S. From a structural standpoint is rig reductions. Oil working rigs are starting to reduce at a pace that's alarming because CapEx in the U.S. has not been as strong as you would like to see. Now, those rigs are producing more crude than they did in the past, again, due to technological advancements. But if we don't get assistance, and I don't mean necessarily financial assistance, but assistance from the regulatory structure, then the production will start to fall off in the U.S. And if the U.S. production falls off, then you're going to see prices rally in crude.
Where more broadly, especially as you look across some of the decisions that are going to need to be made on a geopolitical front over the next few months and even into next year on production, where could that have a more outsized impact on where we just see the prices for WTI and Brent moving?
Well, you don't want to see, you guys mentioned the attack on Israel over the weekend. You don't want to see that continue to flare up. You really don't. Israel is one of the only successful countries in that region that doesn't have oil. So if they started fighting back against some of the proxies, some of the countries that support these groups, and it's over my pay grade to say which countries those are, but if Israel decides there's a country that matters from that standpoint, you're going to see a spike in Brent. When you see a spike in Brent, you see a spike in WTI. The interesting thing about crude oil is it is very much a structural supply and demand market. How much oil is out there and how much oil are people using? And that's it. That's the way we derive price. And that's why you see these wide bands, but sideways bands in crude oil charts over long periods of time, because there needs to be a disruption in one or the other. Now, demand disruptions or accelerations happen gradually. Supply disruptions happen all at once, and they're usually from a geopolitical flare-up. So that would be what I would be most concerned about.
Bob Iaccino, who is the Path Trading Partners co-founder and chief market strategist. Bob, thanks so much for taking the time here this morning.
Good to see you guys. Good to see you, Brad.
Thanks so much. Coming up, TD Cowen raises its price target on Apple. We've got the analyst behind that call on the other side of this break. You're watching Yahoo Finance's Morning Brief. We're keeping an eye on Semi this morning as you're taking a look at shares moving higher by about 11% on the rise following its earnings release here. And this was one I was tracking coming into the start of trading, one of the larger companies reporting before the bell this morning. And of course, for the company, it's been pretty lackluster year-to-date performance. I don't know if we can toss that chart up, but I was taking a look at the stock, and there you go. It's down by about 6%, especially at a time where you've got so much fervor around the semiconductor trade, really led by this larger surge in demand for AI chips here. On Semi has been one of the larger laggards, and it's a larger question of what this company has to communicate going forward from here about its own strategy to make sure that they're capitalizing on the larger demand that we're going to see going forward for generative AI. But I know that the company's earnings call, I think, should have just gotten underway at the start of our hour here.
Brad, I have to do more work on Semi, but a couple things I don't like. I don't like that the chart for this company has not necessarily moved in lockstep with a lot of the hot AI Semi trades. So to me, that's a bit of a red flag. And then just from a fundamental perspective, it's hard to see. I need to go back and listen to that earnings call, but it's hard to see what the market is locking in here. Just from a fundamental perspective, year over year, you had sales down, you had gross profit margins down on a non-GAAP basis, operating margins were also down, and then earnings per share was also down. Now, the company is touting a new, I guess, agreement or tie-up with Volkswagen, but nonetheless, fundamentally, I just don't think this quarter was there. I don't know if this is maybe perhaps short covering, people expecting worse. And I also am not 100% sure what's the read-through here to Intel's quarter that's coming up soon.
Yeah, it seems like, and you're right to call out Volkswagen, it seems like for On Semi, especially within the automotive industry and where they're aligning with some of the key partners there and trying to really capitalize on the computer on wheels type of phenomena, and well, not even phenomena, but the shift that we're seeing in the broader industry, that's perhaps where they could be leaning a little bit further, where everyone else, a lot of the other major competitors, are really focused in on building out the data center as of right now.
And something else I don't like, just leaving viewers on this from a fundamental perspective, sales down sequentially or quarter over quarter in each of the company's business segments. That's not something you want to see from companies, but then you definitely don't want to see it inside of a hot AI market. So more work to be done on this company.
Yeah, and double-digit declines year over year in all of those business segments as well. Everyone, we've got all your markets action ahead. Stay tuned. You're watching The Morning Brief. We're watching shares of Apple tick higher this morning after TD Cowen raised its price target on the iPhone maker. The analyst behind the call upping the target from $220 to $250, just ahead of Apple's earnings due Thursday. For more on the call, we've got Krish Sankar, who is the TD Cowen Managing Director and Senior Research Analyst. Krish, great to speak with you here. All right, take us into your thesis around this call. Why upgrading Apple right now?
Yeah, sure, Brad. Thanks for having me. Actually, we're not upgrading Apple. We just raised the price target. Had a buy rating on it for a while. We do like the story. Clearly, the stock has had a pretty good run in the last few months, especially driven by the fact that a lot of the AI-related hype after the Worldwide Developer Conference. The thing that I would probably say is that if you take a step back 6 months ago on the name, there were a lot of concerns. Number one was, share loss in China, especially to Huawei on the iPhone side, no real AI strategy, etc. So I think what you're seeing now is clearly, they articulated some AI kind of uptick with OpenAI, integrated with Siri. Maybe next year we'll start seeing AI-enabled smartphone come through. And more importantly, on the China side, I think you've started seeing share loss kind of like, plateaued. Where I would say the peak share loss in China to Huawei was maybe last October through maybe March timeframe, and now it's kind of like stabilized. So I think you're kind of having a setup where things have turned positive for Apple from a sentiment standpoint.
Krish, how concerned are you that Apple CEO Tim Cook and CFO get on that earnings call and just let the market down in terms of AI? We know pretty much what they're doing. It's unclear how they're going to convey to investors that their AI features are going to magically pop up on devices now, and over the next 2 quarters, everybody's going to need a new product from them.
Yeah, Brian, I think, quite honestly, I think they gave some kind of color during the Worldwide Developer Conference, which was in early June. I think 2 things to keep in mind. Number one is that we are not assuming a massive AI refresh driven by the phone this year. It's going to be more a next year thing. But at the same time, with some of the new iOS software updates, with the Siri and etc., you're going to probably have some AI-enabled capabilities, especially on the software side. So I don't think there's going to be anything a whole lot new coming out on this earnings call that's gonna tell you a lot more color into what's going to come out in September, October timeframe. But I do think that it's going to be more of a software overhaul, and the hardware overhaul comes next year.
What's the biggest money-making AI feature that you think we're going to see on the next iPhone?
Oh gosh, I have no idea. It's like asking what the next killer app is. Quite honestly, the way I would characterize it is when you remember, like when the iPhone came out, in 2007, Steve Jobs spoke about an app ecosystem. No one really understood what apps were. And today we all know how reliant we are on apps for a smartphone. I would probably say that the same way. I think any kind of apps for AI-related or AI-enabled features might probably come in the future more than what it is today right now, because I do think that the market evolves as the capability, gets out there in place.
Krish, it seems like there's some fresh reporting out. I'm taking a look at some of the Bloomberg reports that are saying that some of those AI features are going to be delayed. How much of an impact does that have near term to Apple's results? And especially going into September, where we know a lot of people are waiting for either a new phone or to just be able to take advantage of some of the OS upgrades.
Yeah, sure, Brad. Yeah, I saw that article too, but it just said it's more like a move from September to October just to get some of the bugs out. But the flip side is the argument is, I think when you talk about this kind of software refresh, I think that software refresh should be capable on your iPhone 15 from last year versus buying a new iPhone 16. But one of the things that if you look to the industry people, most of them say things like you'd have like a lot more memory capability, etc., to actually have an AI-enabled smartphone. I would say that if you try to triangulate that, some of those AI-enabled hardware capabilities are probably more available in the 2025 iPhone, which is the next year iPhone versus this year. So I do think that if it's more a software-related upgrade that's delayed by a month, I don't think it really changes the thesis in any way.
Krish, I think I still have a 12 Pro Max right now. If I'm sitting on the sidelines waiting to upgrade my iPhone, should I be waiting until after September, until it's some clarity that comes forward about which features are going to be available in that first tranche of upgrades that go into the operating system?
Yeah, so Brad, I would probably say there's a lot of people who are actually in iPhone 12, right? And if you look at it as like a 3 to 4 year upgrade cycle, I think there's a lot of it is on the 3 year, but let's just, for argument's sake, it's 3 to 4 years. I think it is time to upgrade the iPhone from 12 to the 16 when it comes out in September. That is the hardware, but the software feature will probably get integrated, like maybe in September, October. That even last year iPhone should be capable of doing it. So to me, the timing of any software upgrades should not necessarily matter on what your hardware purchase is going to be.
Thank you for that come to Jesus moment, Krish. I needed that this
We're going
morning.
to get you a new phone. But look, I mean, maybe for folks like Brad, Krish, maybe he's just waiting for the new foldable iPhone. I mean, there's been chatter.
No, I'm not.
No, you're not. You don't want the foldable phone. But
No, I'm not.
How do you think a foldable iPhone, like there's been some speculation, is that a big catalyst? And why would Apple even entertain a foldable phone? It doesn't seem, I mean, just this works fine, Krish. It works fine.
Yeah, the foldable has been spoken for a while. Obviously, Android, Samsung has a foldable phone, Huawei has a foldable phone. A couple of things to keep in mind, right? I think now the rumor is that maybe in 2026, Apple will have a foldable phone. I think if you just take 2 steps back and look at Samsung, for example, there are multiple SKUs of smartphones, and this foldable phone probably sells like 10 million units a year. If you look at Apple, when they come out with a new iPhone, let's say iPhone 16, the expectation is they're going to sell like 80 to 90 million in a year. And if you have that many units with a foldable screen, the risk of, you need to make sure that it's completely risk averse from a standpoint of all the bugs are being sorted out. And the challenge with some of the foldable phones is like the number of times you can close it and open it, the reliability and how it features. And I think for someone like Apple, because the scale is much larger, it has to be completely de-risked before putting it into the marketplace, compared to some of the other phones where you have multiple SKUs with smaller units per SKU compared to the Apple. So that's why I think, you're seeing some of these delays. But at the same time, I think the foldable phone, I don't have one, but like some of the people I've spoken to, I would really like it. It does obviously enlarge the screen, kind of think of it as a mini iPad kind of capability. But I do think that there's probably a use case for it. But to me, it seems like it has to be completely de-risked because there are still some potential reliability with the screen, the number of times you can fold in and fold out.
I'm open to trying the foldable iPhone, Brad. I remember when I got a Motorola Razr back in the day. I was in college, and I was the coolest kid in school. I was sending my little text messages there, listening to my Usher in my car, and I was damn cool. I'm willing to give Apple a chance, Brad.
You couldn't even download nice and slow from Usher to that phone.
And those were good times. All right, Krish Sankar, TD Cowen, Managing Director and Senior Research Analyst. Always good to see you. Thanks for hopping on with us on short notice.
Thank you very much.
All right, does the small cap rally have more room to run? Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets, is still confident in the trade, at least for the short term. But so far, earnings reports don't support a clear shift in durable leadership. And I know, Brad, you really have been digging into this note from Lori. Another great note. I'm a big fan of Lori.
Yeah, one of the charts that kind of stuck out to me from the note was only 2 companies right now in the Mag 7 have really outperformed since the end of June. And I know that's only really looking back at essentially the July month. But as we're taking a look at this chart, 2 companies will pop out and do pop out. And largely, it's Apple and Tesla. Now, let's also remember the longer form time span. If we're taking a look at Tesla here, for instance, where that company essentially jumped, especially after outperforming what the weakened expectations were for how many deliveries and produced vehicles they were expected to see. And so it's a combination of that, plus looking at, for Apple, them finally saying that they're going to get in on some of the larger generative AI type of announcements, and after kind of sitting on the sidelines waiting for the market to tell it, and that is typical to Tim Cook operational strategy and procedure, waiting to see what the market is telling it about what kind of features it wants, and then saying, okay, now let's go into development phases. Now let's go into the announcement. And WWDC was the core and pivotal moment, perhaps, for them to really put that front and center among developers and some of the potential consumers, even though we do have some reports out from Bloomberg this morning that some of those features could be a little bit delayed here.
Yeah, I really enjoy that chart, Brad, because I think it's a wake-up call to a lot of investors. One, in life, nothing lasts forever. And number 2, stocks don't go up in a straight line every single day, despite what I think a lot of pundits would suggest happens out of there. A lot of these stocks, AI trades, popular names, have really come under a lot of pressure. And to that end, on my opening big podcast this morning, I talked to Drew Pettit over at Citi. He's the director of U.S. equity strategy, and he spoke to me about how investors should be playing the AI trade right now.
take your profits in your AI winners right now. I think it's a good time to bank some of that in tech, in communication services.
So I'm listening to a guy like Drew. Drew came out in the early part of July, said, laid out his case, really fundamental, nitty-gritty type of stuff, saying probably the top is in on AI. Go find other stocks to buy. And there's nothing wrong with that. There's a whole other market out there. In fact, 493 other stocks in the S&P 500 besides 7 top tech names.
All right. People can catch that full episode as well, right?
I want to read the promo. You can catch the full episode of the Opening Bid podcast now on Spotify, and it airs every Monday, Wednesday, and Friday at 8 a.m. Eastern Standard Time. I should know because I am just taping so many of these things.
I was teeing it up for you to read the promo. An alley-oop, if you will.
I appreciate you. All right, coming up is the Fed about to signal a big change that could impact markets. We'll discuss what you should watch for in Wednesday's Fed decision. That's next on Catalyst.
It's just after 10 a.m. here in New York City. I'm Madison Mills alongside the Brian Sozzi. He is in today for our very own Shauna Smith. Let's dive into the catalyst moving markets today.
All right, stocks mixed ahead of a massive week for all things macro, data, and earnings. A slew of big tech companies like Apple and Microsoft are set to put markets to the test after disappointments from 2 Mag 7 names last week. Plus, we get insight from the Fed on the timing of rate cuts, if any at all. We'll discuss the next big catalyst for the market rally.
Yeah, it's a big week. Also, though, today, value meals seeming to be more of a headwind for McDonald's than a boost to revenue as U.S. sales slow. We're going to dive into those results and what they tell us about the consumer.
Plus, Bitcoin is on the move, chilling out just under that $70,000 mark after former President Trump hailed the cryptocurrency at the Bitcoin conference over the weekend. We'll talk to Bitcoin enthusiast and professional capital management CEO Anthony Pompliano about the outlook for crypto under each presidential hopeful.
But first, we're going to get to our big story. One of the top catalysts for markets this week is that upcoming Fed decision. While most investors don't expect the Fed to cut rates this week, we could get insight from Fed Chair Jay Powell's remarks about any potential upcoming cuts. Traders now pricing in a 100% chance of a cut in September. That's according to the CME Fed Watch tool. Our very own Jennifer Schomburger is here with us to talk about what we need to know ahead of the meeting. Jennifer, it's great to have you. So I know that we all like to dive into and dissect every single word that Chair Powell has to say. What do you think needs to be the biggest change this week for investors to get even more confident about a potential September cut?
Good morning, Maddie. Yeah, I think there's two main things I'm looking for, watching for this Fed policy meeting for the Fed to signal and set the table for rate cuts later this fall. First, I'm looking for changes in language to the policy statement. Are they going to tweak key sentences that we've seen in that statement? One, towards the top, that there's been modest progress on inflation, or that key language that's really been in the statement since January, that the officials don't expect to lower rates until they've gained further greater confidence that inflation is falling back to their 2% target. Now, I'll also, of course, be listening to what Chair Powell has to say in his press conference, and I expect him to reiterate what he said in his last public comments before the blackout period, which is that inflation in the second quarter is giving the Fed somewhat greater confidence that prices are returning to their 2% target. Now, I don't expect that he's going to offer some sort of calendar guidance, right? That would be very out of character for the Fed. He's likely to reiterate that they're going to make decisions meeting by meeting. And the reason for that is they don't want to tie their hands. If the inflation data does not cooperate, they don't want to commit at this point.
Jen, well, good to see you. I'm really happy the Fed's not cutting rates this meeting because I have a 7-month CD maturing in like 3 days. So I'm going to roll that back over and make some more free money from the government. But
they're going to move slowly, Brian. Don't worry. They'll move slowly.
Fair enough. You know, I've been hearing from a lot of folks I've been talking to on the street, Jen, that while they're willing to embrace a rate cut in the fall, now there seems to be this thinking emerging that maybe a rate cut would not signal good things for the economy. I think I talked to Citi's Drew Pettit this morning, and he surprised me by saying Citi's team is expecting a mild recession in the fourth quarter. I haven't heard the word recession in more than a year.
Yeah, I mean, everyone's always on the lookout for the recession, right, Brian? Like, we've seen the inverted yield curve for how many months now? How long has this been going on? And yet we see growth continue to surprise to the upside in the second quarter, clocking in at 2.8%. So you kind of have a Goldilocks scenario. That said, the Fed is now looking at the labor market more closely than the inflation side of things, because that has been cooling, right? The unemployment rate ticking up to 4.1%, up from 3.4% last year. More people trying to join the job market, but not able to find jobs as easily. So this is really a risk management equation for the Fed. They know that the job market will peak after the economy. And so if you've seen great deterioration in the job market, you're too late. The recession is here. And I think that Powell is keenly aware of that. He has said that the Fed needs to cut well before inflation falls to 2%. So that's why I think the Fed is really looking at September to try to ensure this soft landing. That said, it has been historically very difficult to engineer a soft landing, and former Fed officials I talked to are not sold that that is indeed going to be the case this time around, which jives with what you're hearing from Citigroup.
All right, Jennifer, great stuff as always. Appreciate you joining us, and I know you've got a busy week ahead, so good luck to you. We'll definitely be chatting again. Thanks so much.
Thanks, Maddie.
Now, continuing the conversation around the Fed, there's a lot of focus always on the Fed's interest rate decisions, but we kind of forget about that other big tool for the Fed, which involves the Fed's balance sheet. The FOMC has reduced its balance sheet drawdown recently, though it does remain above pre-pandemic levels. Here to discuss how this could impact the broader market, we've got Tom Becker. He is BlackRock's senior portfolio manager on the Global Tactical Asset Allocation team. Tom, it's great to speak with you. I wonder if you relate to this. My friends, my mom, when they ask me about the Fed, they are always asking me about when we're going to get that rate cut. They're never talking to me about the Fed's balance sheet. What do investors need to know about the Fed's other big tool?
Thanks, Maddie. Yeah, nice to be here today. A big week as you laid out. So in June, you remember the Fed tapered the size of its QT program. So that chart you just showed, the size of the balance sheet has been declining for a couple years here. We've done some analysis kind of over the last few months, trying to disentangle the degree to which that balance sheet tightening has transmitted into financial markets. And the conclusion we've come to is this QT2, kind of this second round of quantitative tightening, hasn't quite tightened as much as maybe intended. That can help to explain why the economy's been so resilient, so robust, and maybe has defied some of the Fed's expectations when they set the pace. So an element of this is starting in June, the Fed is actually going to be reinvesting a larger share of the balance sheet. So initially they were running down about $60 billion a month of treasuries off the balance sheet. They've tapered that back, so only 25 a month. And that has an impact on fiscal policy as well in this environment. So some events this week that we're going to find out about how much Janet Yellen and the Treasury are going to issue this upcoming quarter, how big the auction sizes are going to be. And so to the extent that the Fed has tapered the size of that QT, means that investors won't have to come in and take down as large a share of those auctions, because the Fed's going to be rolling that large balance sheet that they have. So $6.6 trillion, still a materially large balance sheet, and still impacting financial markets in an ongoing way.
Tom, I hear what you're saying here, and to me, it feels like a sneaky risk that not a lot of people are paying attention to. Is anything that you're saying right now, is any of this priced into stocks?
I think it is. It's broadly priced into financial markets right now, and I don't think there's an expectation that the Fed's going to rock the boat on its balance sheet portfolio from here. They made that big move in June, but you have heard some kind of rumblings about the composition of the balance sheet. So how long the duration is of the bonds that are on the portfolio, how many mortgages are on the portfolio. And so as we go quarter to quarter, this is definitely a slow development that I think matters. The balance sheet, of course, impacts the term premium. The comment we just had about the inverted yield curve for years here. Part of that's related to the Fed having suppressed long-term yields, having bought a lot of the duration out of markets. And so to the extent that kind of the 4 rounds of quantitative easing, Operation Twist, all these successive programs since the financial crisis, that does have an ongoing effect on financial conditions. We think that is underappreciated. Don't see it as a risk here in the next couple quarters, but as we move forward, if the economy remains resilient, if a couple rate cuts kind of reignite economic activity, I think the balance sheet could come back into question again next year as, what do we want the steady state to be? What do we want the composition to be? These are things we're thinking about on the team. Since we focus mostly on fixed income, we're thinking about the steepness of the yield curve. This last month, we've seen kind of stocks not take some of this steepening of the yield curve that well. And so I do think that's a risk, something we saw in Q3 of last year, kind of the steepening of the yield curve being bad for stocks and bonds. Certainly something we're keeping on our radar.
So, Tom, are treasuries still a risk mitigator then for investors?
It's a great question, Maddie. They have not been. The last 3 years, we've seen one of the highest all-time correlations between the ag and the S&P 500, so that rolling monthly correlation. The ballast that people expect from the fixed income in their portfolios hasn't been there. Equities have been kind of where you've gotten your offense, and bonds have been kind of a weaker form of offense. They haven't been playing defense in a portfolio construction sense. When we look back historically, that's consistent with inflation being above target. You just showed core PCE still 2.6%. So on the way, hopefully, to the Fed, closer to the Fed's target, but above. And so that level really matters, because the Fed's ability to kind of have the Fed put or be able to kind of, cut and ease if there's a real concern to markets, it's mitigated somewhat if inflation's sticky above target. We see a lot of reasons why geopolitics, supply chains, a strong services economy, lots of new workers in the U.S. economy. We see a lot of reasons why that inflation rate is not going to fall reliably below 2% for prolonged periods of time. And so we think this is kind of a post-pandemic new normal, where we've got kind of more resilient inflation missing a little bit to the high side. And that means that bonds aren't that great ballast in your portfolio. You've got to look for things that are diversifying to your equity risk. And so that's why we run a lot of products that are kind of liquid alternatives, other diversifiers where you can get your offense in terms of your return, but it comes in those months when equities maybe aren't doing as well.
Interesting stuff here to kick off the week. Tom Becker, BlackRock Senior Portfolio Manager on the Global Tactical Asset Allocation Team. Good to see you. Appreciate it.
Thanks, Brian. Appreciate it. Bye, Maddie.
All right, let's turn to stocks because the market has undergone massive changes in recent weeks. Trades that were hot at the start of the year are beginning to lose steam. Tech stocks, the yen, the Hang Seng Index, and copper futures all falling in the last month. And Maddie, I think this is just a really good reminder to investors. Nothing goes up in a straight line. And I think if you want to find good long-term investments, you have to look beyond 7 stocks in the S&P 500. There's 493 other things out there that are worth your time. Go read a 10K. Go read Yahoo Finance stat tables on these companies. Go find them, and you may find a good stock to own.
I love that you pulled this chart up for us to include today, Sazi.
I appreciate it.
Well, it's really important because we do talk about those tech stocks losing steam, but we often lose sight of some of these other popular trades that were a little bit more, frankly, interesting, right? You look at something like copper that's had a huge run up this year, now moving to the downside, the dollar yen, obviously critical to watch as we head into that Bank of Japan decision this week from their central bank. Having said that, I want to look at the Russell versus the Nasdaq. The Russell is going to be that small cap trade that we've been talking about investors rotating into. Last week, the Russell was up 3.5% at the end of the week. The Nasdaq closed down 2.5%, and we've been seeing this play out over the past 3 weeks here, this rotation trade. So one big question I have for folks that we're speaking with is it already too late to have gotten in on the small cap trade, or is there still room to run
Well, you like to
there?
nerd out on markets, Maddie. I'm still trying to figure out this move into small caps because growth is slowing down. Rates haven't been cut yet. So to me, this doesn't feel like a fertile backdrop to small caps. What the hell do I know? I mean, these stocks have been on fire the past few weeks.
I think it is very company specific, and we've heard that from a lot of guests too, is don't necessarily own the ETFs, the basket, own individual stocks, but it takes a lot more time and a lot more effort.
So true. All right, we'll be right back with a lot more market moving insight. Love that. You're watching Catalyst.
McDonald's dealing with a more cautious consumer. Second quarter earnings fell short of Wall Street expectations, sales declining for the first time since 2020 amid a global slowdown from consumers. For a deeper dive into the company's latest results, we've got Nick Setien. He is Wedbush Securities Managing Director and Equity Research Analyst. Nick, thanks so much for being here. So, a lot of misses in this print, but we're seeing that the stock is up over 3.5%. What do you make of the market reaction here?
Well, first, thanks for having me. Buy-side expectations were much lower, so down 70 bips in the U.S., particularly when, margins were actually much better than expectations as well. Guidance, reiteration of the margin guidance for the year. I think there was an expectation that they might have to take down the margin commentary. So essentially, it was better than feared, and that's why you're seeing the stock move up.
Nick, folks that I've talked to on McDonald's recently, let's say the past month, have suggested their breakfast business has fallen off a map because consumers are cutting back what they're buying and they're cutting back on breakfast. Have you been seeing that, and how big a headwind is that? Because as we all know, that breakfast business really is historically the moneymaker for McDonald's.
Well, especially versus 2019, yeah. The breakfast business is not back to what to where it was in 2019 post-COVID. It's recovered a bit, but certainly not back to where it was, in 2019. Now, year over year, it's holding its own. I think there's weakness across the day parts, not just breakfast. Whether it's lunch or dinner. Late night is actually the only strong point across QSR, believe it or not. So. I do think there's some weakness year over year in breakfast, but I think it's not specific to breakfast. I think it's across the day parts.
Nick, why is the late night business on fire?
Specifically for most of QSR, I think there's still a little bit of a normalization in terms of hours, frankly. So it's not that there's anything special going on around the late night customer. It's just that now that there's a little bit more labor availability, they can keep the stores open a little bit longer.
Well, it's interesting. I know that you mentioned that the $5 meal was cannibalizing the rest of the menu. McDonald's kind of throwing cold water on that, saying that it's not having an impact yet. But I want to end by sort of broadening this out, Nick, because we're hearing so much commentary from, Chipotle, McDonald's, obviously last quarter with Starbucks about the pricing question. Are we seeing a tempering of company pricing power when it comes to the pressure consumers are facing with inflation? Or is this indicative of a really significant softness in the economy that we are starting to see come up in these company earnings calls?
It's not the latter. This is not a top-down issue. This is a bottom-up issue, in my opinion. And we just took too much pricing for certain segments of the population. And we saw this again in 2016 through 2018, right? So every time we have restaurant prices going up more than grocery prices, you see, a third of transactions within QSR, particularly that lower income household, it's direct meal replacement, right? So every time grocery prices are lower, you essentially have a third of your customers eating out less or using, let's say McDonald's, especially the value menu, less as a meal replacement, and they're going to the grocery store. And that's what's happening now. The $5 meal was supposed to be an answer to that problem. It's not working as well as they hoped, frankly, because it's also cannibalizing the higher income customer that doesn't really need it. And so I think they have to find a better solution.
Nick, bottom line, you're getting 4 McNuggets as part of that deal in a small soda. You're not getting filled up on that stuff. Come on, let's just be real. Nick Setien, Wedbush Securities Managing Director and Equity Research Analyst. Good to see you. Tell our friend Dan Ives over there hello.
Will do.
All right, Tesla getting a bullish call from Morgan Stanley analyst Adam Jonas, calling the EV maker a top pick in U.S. autos, overtaking Ford. Jonas saying Tesla now has the opportunity to generate positive cash flow, pointing to several actions which have helped lower the break-even point. Adam Jonas, always, of course, Maddie, a market mover on all things Tesla. I would just point to, I just think we're getting better results out of other EV makers besides Tesla. When I talked to GM CFO after earnings last week, Paul Jacobson struck a very bullish note on how much, I think their EV sales are up 40%. They have a bunch of new models coming to the market that in many respects undercutting Tesla. That Tesla earnings report was not so great. So not to really poo-poo this Adam Jonas call, I mean, I think you're getting some better results out of their competitors.
Yeah, he talked about some of the defense mechanisms of Tesla, right? Things like cost cutting, restructuring, that has helped to kind of pull off the downside from being too far to the downside, right? But I think the big question for Tesla is how are they going to be offensive moving forward? Are they going to be able to have that robo-taxi? Sounds like that announcement still getting pushed back. Are they going to have a cheaper model moving forward? We also don't know when that's going to happen. Is the Cybertruck really the catalyst that Elon Musk reported it to be?
I'm seeing these things everywhere, Maddie. They're starting to pop up. I mean, I've seen one in orange and black within the past 2 weeks.
I haven't seen any non-silver ones. When I see them in Manhattan, it's like the weirdest combination of aesthetics in the world.
They're just big, dumb, stupid pieces of metal. I mean, they don't fit in a parking spot. I mean, if more of these start to hit the road, you're gonna have to reinvent roads. I mean, they're that big.
Well, it is a good point, but Kevin O'Leary was on our show talking about how he said it's ugly and that's a good thing. That's why I'm investing, because he thinks nice. it's gonna be this thing that I mean, we're talking about it, right? Because we're seeing it and it sticks out.
Right. I mean, and one key risk, I would just add this too. If there's a change in the White House, this $7,500 tax credit to buy EV makers, if that goes away, if Trump wins the White House again, and that's a removal of a major catalyst for the entire EV industry, and I don't think that's priced into Tesla shares at all.
And Musk said on the earnings call that that's going to be bad for his competitors, but worse for them than it's going to be for Tesla. Whether or not that's true, I think is the big question for them.
May find out.
Right. All right. Well, we're going to move on to another trending ticker here. Philips shares moving to the upside this morning to the tune of 13% after seeing its second quarter comp group sales climbing 2% from a year ago. Demand in North America offsetting the pullback in China. Yahoo Finance's Anjali Kamlani has the breakdown for us. And Anj, this pullback in China story is not one that is specific to this company, but how big of a deal was it for this earnings print?
Well, they definitely saw the pullback, and I actually did speak to CEO Roy Jacobs earlier, and he did talk about how the company has had a very long history in China. This is not a new area. This is not a new market for them, so they're not even worried about it. They're like, it is going to come back, and that's where they stand on that. But Philips is an interesting story because we know, of course, the overhang has been from that CPAP, from the machines recall that they've had in the past, and they've sort of gotten over the hump. They're starting to build back credibility, starting to see a little bit of uptick in the market now, and that's where you're seeing this recovery and seeing the stock up. Even with the earnings miss, they did have a slight revenue beat. I also did talk to Roy about one thing that has also been a potential future overhang, which is GLP-1s. We know that's a big story for medical devices, and with Eli Lilly talking about its trial results with sleep apnea, how does that impact a market leader like Philips? And so Roy actually said that because the sleep apnea market, there's such a big undiagnosed market, it actually will not impact the company and could actually be a tailwind. And so I've heard that from others as well. A competitor, ResMed, has said pretty much the same thing, and that it could in fact be the opposite, create more demand and more awareness for the company. So that I thought was also pretty interesting. And we do know that, of course, with the layoffs that they've had to deal with, they're really well into their 3-year restructuring plan and just staying the course. Roy said that that's pretty much where they stand right now, just continuing on that course, right sizing and making sure that they can recover from the losses of the past.
It's a great reminder of kind of the widespread idiosyncratic company impacts that GLP-1s could have, right? Even a company with, sleep apnea, right, treatments could be impacted. So really interesting. Anj, thank you so much. Really appreciate it as always. And coming up here, former President Trump spoke at the Bitcoin 2024 conference over the weekend. What could that mean for the future of crypto policy if he ends up in the White House come November? We'll discuss that next. Former President Trump speaking this weekend at the Bitcoin 2024 conference in Nashville, vowing to create a permanent stockpile of Bitcoin in the U.S., as well as making a pledge to fire SEC Chair Gary Gensler on day one. While the former president is making a big appeal to push for support from crypto supporters, partially in an effort to peel voters away from RFK Jr., he's not always been the biggest proponent of Bitcoin compared to where he is today. In 2019, then President Trump tweeted, "We have only one real currency in the USA, and it's stronger than ever, both dependable and reliable, and it's called the US dollar." Even as late as 2021, he called Bitcoin a scam against the US dollar. Now juxtapose that with what former President Trump said here on Saturday.
This afternoon, I'm laying out my plan to ensure that the United States will be the crypto capital of the planet and the Bitcoin superpower of the world, and we'll get it done.
So the big question is what Trump would actually do in office if elected regarding cryptocurrencies. But for now, President Trump fully embracing Bitcoin. So joining us now to discuss the reaction to President Trump's speech, we've got Anthony Pompliano. He's Professional Capital Management's CEO. Anthony, it's great to speak with you here. So obviously, former President Trump really trying to lean in with these crypto supporters. Do you buy it? Do you think that when he gets into office, he's going to be enacting all of the policies that he has purported over the weekend if he does, in fact, win in November?
Yeah, I think there's two key components to this, right? The first is President Trump seems to have gone through a very similar trajectory to most Bitcoiners. Is when you first hear about it, you don't believe it. Then you kind of do some work on it. Eventually, you become convinced of the value, and then you start telling other people about it. And so that seems to be, a very similar trajectory to many, many people that I know in the industry. The second thing is that I do think you can look at who is around him, right? If you look at his sons, if you look at some of the advisors that he has, if you look at even folks that we know have been talking to him about Bitcoin, specifically somebody like Vivek, et cetera. I do think that it is highly likely he is much more sympathetic than he was previously. Now, the question is, what does that mean? What will he actually do? And, unfortunately for all candidates, whether it is Trump, if it's, Harris running against him, if it's RFK, et cetera, we don't know what they're going to do until they're in office. And so the best thing that we have to go on is what they say. And, many people will rail against political candidates and say, they just make these empty promises, they don't fulfill them. But right now, we can only judge based on, what actually is being told to us. And so, so far, he said all the right things. But, unfortunately, we don't know what any candidate will do until they're actually the president.
Anthony, good to see you. If President Trump does win the White House, day one, he cans SEC Chair Gary Gensler. How bullish is that for crypto?
Yeah, I mean, look, obviously, the regulatory environment has not been as kind of conducive to the industry as I think many people in the industry want it to be. With that said, I do think that we built a $3+ trillion industry, even with a regulatory environment that maybe wasn't, as friendly as people desired. And so regulation definitely matters. Regulation being, kind of more friendly, more clear, et cetera, would be helpful. But I think that the regulatory conversation is only one component of a much bigger story here, which is, kind of the truth wins out. And what we've watched globally is that this technology is something that people want. These assets are something that people want. And as you can see in kind of the price, people are going to continue to buy them regardless of what the United States regulatory policy is. And so from an industry standpoint, yes, crypto and Bitcoin will continue to be successful, without kind of a friendly regulatory body. But in the American viewpoint, yes, if we want this built here, then we do need to have some sort of friendly regulatory bodies. And it sounds like, multiple political candidates are promising that.
Well, I want to talk about the success of Bitcoin that you are mentioning here, Anthony. Let's take a look at the 5-year chart of this digital asset here. Less than 2 years ago, Bitcoin was under $16,000. That's a decline of over 75% from its current levels. I get it. We're going to blame it on FTX, whatever. But how do you have so much confidence in this asset class continuing to grow, by Michael Saylor's point of view, by 20% every single year, given that, again, just 2 years ago, it had this huge crash?
Yeah, well, I think if you go back to kind of 2022, 2023, yes, some of it was definitely FTX, but Bitcoin was already down pretty substantially off of its highs before the FTX collapse occurred. And a lot of that was just interest rates. And the Fed said that they were going to destroy demand. They did a fantastic job of destroying investor demand in many assets, not just Bitcoin. And so it wasn't just one thing. I think it was kind of a confluence of events that drove the price down. But really, what you have to believe to understand that Bitcoin has a very high probability of continuing to go up over many years to come is that the US dollar structurally is going to be debased. If you go back and you look at Republicans or Democrats, whoever is in office, they continue to increase the national debt. Today, the national debt hit $35 trillion, and there are no signs of slowing down. And so if they're going to continue to devalue the currency, then anything priced in that currency will go up. It's why the stock market continues to go up at around 8 to 9%. Now, if Bitcoin continues to go up at 20% a year, that actually would be very slow. That would be a significant slowdown in the current kind of price appreciation. Over the last 5 years, Bitcoin has actually been going up at closer to 45 to 50% on an annualized rate basis. And so seeing a 20% annualized rate over the next, call it 20 years, is not really that kind of crazy when you see just the devaluation of the dollar. You continue to see a fixed supply asset that millions and millions of people around the world are waking up to every month and saying, hey, I want this thing. And it's not just the US dollar that's being debased. It's also all of the fiat currencies around the world. Anyone who lives in a fiat currency regime is saying to themselves, maybe I should get a little bit of Bitcoin in case it catches on.
We've heard some chatter, Anthony, that Vice President Harris and her team may be looking to reset the relationship with the cryptocurrency community. If they were to make that outreach, is that something that the community will trust? Will they embrace a potential President Harris?
Yeah, look, as in any industry, I think you're going to get a variety of reactions, right? There's going to be people who say, hey, I don't want kind of have a conversation with you. I think you'll have plenty of people who say, well, I would love to have a conversation with you. That's how, what makes up industries, especially industries with hundreds of millions of people in it. Now, what I do think is that we need Bitcoin to be a bipartisan asset. We don't want it to only be accepted by one side of kind of the political spectrum. And so that outreach or that reset, I think would be a welcomed thing by many people in the industry. Now, with that said, again, just as I said with President Trump and kind of words versus action, the same thing here is if you want to reset relationships, I think there's a lot of people who are saying to themselves, okay, well, you're in power right now. What are you going to do, right? There are a couple of months before the election. Show us what that reset looks like rather than just tell us what it is. And, there's people calling for all kinds of different maybe milestones or kind of things that would, really prove that there is this reset and they're serious about it. But I think just action over words is really what's going to end up convincing people that either side of the political aisle is serious about this asset class, this industry, and a lot of these campaign promises.
All right, well, it sounds like given that it has become a little bit of a political football, at least in the campaign, it's becoming that bipartisan asset for now, Anthony. Thank you so much. We'll continue to chat with you about this, I'm sure. That was Anthony Pompliano. He's Professional Capital Management's CEO. We are going to have all of your markets action ahead, and we're also going to continue to focus on that upcoming November election and what you need to know. So stay tuned. You're watching Catalyst.
Vice President Harris's presidential campaign has reported $200 million in contributions since President Biden announced he was stepping down from the top of the ticket, with the campaign claiming that 2/3 of donations came from first-time contributors this cycle. With base turnout sure to be a key factor in November, can the Harris campaign keep up this momentum through the fall? Montgomery, Alabama Mayor Stephen L. Reed, who is also a Harris 2024 surrogate, is here with us. Mr. Mayor, good to see you here. Maybe you could help us understand some of the enthusiasm around Vice President Harris's campaign.
I think there's a lot of enthusiasm around her campaign because of the ideas she has for the future, certainly to strengthen this democracy, to make sure reproductive freedoms are protected as well, and also to make sure that Americans have an economic opportunity that gets them ahead. And she's very sensitive to that. She understands what we're dealing with on the local level as mayors. She understands that because of her proximity and being a local elected official. So she is very sensitive to what the average American is going through. And I think that's been a hallmark of the Biden administration, is having an ear to the ground and making sure that not only their policies, but some of the steps that they can take assist Americans economically and financially.
There's this idea that she has been in this quote-unquote honeymoon phase post-announcement that's led to a huge surge in excitement. What do you think she needs to do to maintain that energy and really put it into the polls come November?
Well, the great thing about this is we know who former President Trump is. Most Americans don't know who Vice President Harris is. So while there's a honeymoon period here, I believe it has the factor to sustain itself because as more Americans learn her personal story, learn why she went into public service in the first place and what she has done, I believe more Americans will be excited about her candidacy to be president. And, in order to maintain that, we're talking about 99 days. She has the only campaign that has offices across several states, that has a volunteer list the size, almost 200,000 now volunteers, getting up to that level. Those are people who want to knock doors and talk to their neighbors, talk to their coworkers about what's at stake in this election and what it means, again, for their pocketbooks, what it means for their savings accounts, their college savings accounts, what it means for their retirement plans. These are things that the vice president and her team clearly understand, and I believe that will help sustain the energy that we're seeing right now because of her vision, again, for the future and what it means for everyday Americans.
We talk to a lot of CEOs of very large public companies here at Yahoo Finance and also very large investors, and they tell us they do not know what the vice president stands for in terms of the economy. How is she going to bring down inflation? How friendly will she be on the regulatory front? Based on your knowledge of her economic plans, what does she stand for?
I think she has some things that are similar to President Biden, but I think she also has some priorities of her own. And as her campaign team has dealt with what's happened in the last week, I think they're still rolling that out. So I don't want to get ahead of the team in that regard. But I do know that she has a vision for everyday Americans. I know that she has a vision to make sure that there's economic opportunity, not just to stay above water, but again, to get ahead economically. And they are very sensitive to what's happening with the cost of wages. They're very sensitive to home ownership costs, the mortgage loans, where the price of housing is going in this country and what that really means, but also what it means just for bread and butter issues like the price of groceries and gas. So those things are very similar to, again, I think the sensitivity of President Biden. And I think Vice President Harris has some of her ideas that she's going to be rolling out here in the near future. And I think the American people are going to be very satisfied with that.
You mentioned some challenges amongst your constituents, I guess, from an economic standpoint. What are some of the things they're dealing with right now on the ground economically? What are some of the biggest challenges that you see day to day?
Well, again, certainly the price of groceries going up, not having the dollar go as high or go as far, as we would like to see it. While, unemployment is at a great record low, it doesn't feel that way for the average American. So we're very sensitive to that on the local level. We're sensitive to that at every level and pushing those ideas all the way to the Biden-Harris administration. And those are things that really matter to voters. What are you doing to help me get ahead and make sure that my family is taken care of? And again, I think the vice president has a plan for that she'll be sharing. And I believe when more voters hear the truth and hear the facts as opposed to the fiction, they'll be more in line with a presidential candidate who cares more about them than they do just large corporations. We understand how business works, how the economy works, but you've got to put the worker. You've got to put the everyday American first. And I think that's what we'll hear from Vice President Harris.
In terms of that, I am curious about your take on something that we saw from her in her last election cycle, which is that there was this huge surge in support, specifically amongst black voters, that then started to trail off as we got closer to those voting days. And it's interesting because it feels like she has to walk this tightrope. We've had so many guests come on and talk about how people who are left of left criticize some of her past and people who are right of left also criticize her. I'm just curious, in your conversations with folks, how tough is that, and how should she be approaching that? If she called you later today and said, like, how do I get to the middle of this, what would you tell her?
Well, I think the vice president knows better than any of us how to navigate these lanes. She's now been vice president for 3.5 years. That wasn't the case in 2020. And so I think she's come under a lot of scrutiny and criticism just in that role. So she has grown as a leader. We all do. She's grown from some of the constructive critiques. And I believe that in her role, she just has to tell the American people who she is, why she wants to be president, why she wants to earn their vote, and what it will mean for them in the future and not the past.
Really quick, there's this question about her readiness. Do you find that odd, given that she's already been in the White House for 3.5 years?
I think there's a level of sexism involved in that question. I think there's a level of racism involved in that question. She is apparently ready. She led one of the largest Justice Departments prior to becoming a United States Senator, prior to becoming a vice president. So I think if anyone is ready for the job day one, it is Vice President Kamala Harris.
Really appreciate you joining us, Mr. Mayor. Thank you so much. And thanks for making time of us while you're in New York. We got to talk about your AI trip next time you're here with us. Thank you so much. That was, again, Montgomery, Alabama Mayor Stephen L. Reed joining us in studio. Well, moving on to another story we are watching in the media space. Good news for Disney this weekend. Marvel's Deadpool vs. Wolverine, the latest summer blockbuster, starring Ryan Reynolds and Hugh Jackman, for those who don't know, made over $438 million worldwide in its opening weekend. It's the highest grossing R-rated opening of all time. For more on what this could mean for Disney and the film industry as a whole, we're going to bring in Paul Dergarbedian. He is Comscore's senior media analyst. And Paul, it's always great to chat with you. What does the success of this film over the weekend mean for the future of these film studios as they are thinking about successful ways to bring people into the movie theaters moving forward?
Yeah, that's a great question. I think it really has to do with that movie theater experience, the communal experience. But what gets people in the theater are exciting films that are well marketed. And talk about well marketed. I mean, you look at Ryan Reynolds and Hugh Jackman and the director Sean Levy and other stars, and Dogpool, the famous dog in the movie. They've been everywhere. And if you were not to go to the movie theater this weekend or this week, you're going to have that FOMO factor, fear of missing out, that's off the charts. But I mean, the relentless marketing power of Ryan Reynolds, who really has shepherded the Deadpool franchise to this incredible result. And he even said, and I wish I'd come up with this, that Deadpool and Wolverine is like the first 4-quadrant R-rated movie, and it meaning that it appeals to all audiences, young and old, all genders, and really globally across all cultures. So that's how you get to $205 million opening weekend domestically alone, and over 438.3 million worldwide. Pretty incredible to watch, considering where we were back in May, where it was all gloom and doom after a very slow start, the historically low Memorial weekend. Then Bad Boys Ride or Die came on, and that gave us an indication that there were going to be some performances by movies that would be in excess of what the projections were for those films, like Inside Out 2, Despicable Me 4, Twisters, and now, of course, to end Quiet Place Day One. So what a run of hits, a string of hits that the industry really needed.
Paul, does Disney CEO Bob Iger have his swagger back?
Does he have what? What
his
again?
Swagger back.
Oh, yeah. Yeah, I think so. I mean, look, Disney was very quiet in the early part of the year, Brian. They really didn't have a movie out there. And after the Marvels didn't do very well, and some Pixar movies didn't do very well, and it was a really rough time, to come back with a vengeance like this. I mean, right now, Inside Out 2 is the highest grossing animated movie of all time, with over $1.5 billion globally. Despicable Me 4 closing in on $1 billion. I mean, we went from bust to boom really in about 2 months. If you looked at the headlines back in May, compare and contrast those with today, after this incredible performance by Deadpool and Wolverine, the contrast is stark, but it puts a fine point on the fact that the movie industry is very volatile. It's a fragile ecosystem. Every little change affects things in a profound way, whereas streaming is so enormous that that ecosystem can weather the storm in a way that theaters may not be able to. If you have 2 or 3 weeks of downtrending box office, it seems like the sky is falling, but boy, things can come back really fast, and it sure did.
Paul, final minute here. I got to talk to you about the Olympics because I'm certainly watching it. I know obviously millions of others are, but what does it tell us specifically about how much success sports streaming can lead and really yield for these streamers?
Yeah. Well, Madison, this is the new frontier for streamers. I mean, to tap into the live sports category is huge for them. And just a couple of years ago, we couldn't have imagined watching live sports on Netflix or on Prime or on Peacock. And here we are. And even though most sports really do, team sports require live viewing, because once it's over, the game is over and you know the results, it's not that much fun to watch it. But the way Peacock has set it up is, I did this last night. I went on, I re-upped my subscription like so many others because I want to watch the Olympics. And you can go to these categories that are in circles that say swimming, equestrian, surfing. Some of these I'm making up, but there actually are these categories that you can click on. And some of these events like equestrian and surfing, actually you can time shift those. You don't necessarily have to watch those live. So it's great for Peacock. I think this is a big deal. Who knew that sports would, for some, save the streaming services? So it's pretty cool.
Yeah, go figure. Well, I'm looking forward to watching more Olympics indeed. Comscore senior media analyst Paul Garabedian, good to see you. We'll talk to you soon.
Thank you. Great to see you.
All right, turning now to a key takeaway for markets this week. With earnings coming down the pike from big names in tech and the consumer, Morgan Stanley's Mike Wilson is sounding the alarm that weak outlooks can hurt stocks that are tied to the economy. When I last spoke to Wilson last week on my opening podcast, here's what he had to say.
We're in the deceleration camp from an economic standpoint. Even though we're expecting a soft landing, it's still decelerating from a top line perspective. And that's going to be really challenging for a majority of companies.
So, Madison, I think this fits with Mike's overall. We should note, of course, the closely followed chief investment officer in Morgan Stanley. Yes. But this fits, I think, overall in his framework that he's still looking for correction. It was just a couple weeks ago where he called out potential for a 10% correction. We're not there yet. And I think Mike remains concerned about the near-term market outlook. And he's right. We're going to a seasonally slow, challenging time for the markets. To his point, outlooks are starting to weaken. So he's making a lot of sense to me.
Yeah, I was just pulling up my notes that I had from the opening bid podcast interview you did with him, which everyone should listen to.
Thank you for the plug.
Yes. But it's critical, right? Because he is one of the only surviving bears on the street, at least the only really famous one, right? We've talked about Marko Kolanovic getting ousted from his post following several years of really missing the market rally here.
If you make bad calls on Wall Street, you're eventually going to get the boot. I mean, you can't keep these jobs making these terrible calls. But Mike Wilson is the man. He's been right so many times in these markets. So when he speaks, I mean, you have to listen to him.
Yeah, and he talked about the market rotation, and he said that he doesn't really buy it. So I think that's also really important for our investors to listen to when you're hearing us talk about this rotation. If Mike Wilson doesn't buy it, something to keep in mind.
Well, I have something else you can listen to, Madison. You can catch the full episode of the Opening Bid podcast now on Spotify. And it airs every Monday, Wednesday, Friday at 8 a.m. Eastern. I encourage everyone to listen because it's just really good stuff, Madison. Of course, I'm talking my own book like most Wall Street people.
There's something about the host. I can't get enough. Love to listen to him. Great insights. My mom loves him. We all love him.
Thank you, Mama Mills. Appreciate it.
Well, thank you, Saz, for joining us today. We had a great time. Thank you so much. And stick around for more because coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned.
Go get him, Brad.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, it's all about the tech trade with earnings from big-name companies like Meta, Microsoft, and Apple. A portfolio manager is going to give you the tips that you need to navigate the market. And fast food chains are still seeing a cautious consumer. McDonald's, the Golden Arches, their earnings reveal how much value meals are going to pay off. We'll get more on that. Plus, the rise of buy now, pay later. I'll talk to a firm CFO about the popularity of the feature and how it's impacting consumers. All that and much more coming up on today's show. But it's a big week for monetary policy as the Fed holds its next meeting on Wednesday. For more on what we could hear on future rate cuts is Yahoo Finance's Josh Lipton. Hey, Josh.
Brad, it is a busy week for investors. Let's start with the Fed here, which is going to announce its latest monetary policy decision on Wednesday. Markets, we know, largely expect our central bank to hold rates steady at its July meeting. That says the inflation picture does seem to be improving. In June, the core PCE index, which is closely monitored by the Fed, rose 2.6% over the prior year. That was its lowest annual increase in more than 3 years. Of course, the Fed is also watching our labor market as well. So on Friday morning, we're going to get the July jobs report, which is expected to show that 175,000 non-farm payroll jobs were added to the U.S. economy, with unemployment holding steady at 4.1%, according to data from Bloomberg. Remember, back in June, the U.S. economy added 206,000 jobs. Bottom line, the labor market is showing signs of moderating. Last month, the unemployment rate hit its highest level since November 2021. Still, some economists we have spoken to here at Yahoo Finance say they are not concerned for now with what they're seeing in the data. Here's what Thomas Simons at Jefferies told us.
One of the things that gives me confidence is corporate profit margins have still been quite healthy. They've come down a little bit, but they've also gone through recent periods where they've gone down and then gone back up. There's always sort of a, culling of the herd or, some sort of refresh that goes on, excuse me, with bigger businesses. But there isn't evidence to me just yet that there's this big push that's going to be looking for cost cutting that way.
Added up, and what does our cooling labor market and the inflation picture mean for Fed Chief Jay Powell and our policymakers? KPMG's chief economist Diane Swank tells her clients that the message is clear. In her opinion, the Fed is not ready to pull the trigger now in July, but is willing to think about rate cuts. A few more months of favorable inflation data make a move in September easier to justify, she argues. Indeed, traders are pricing in a nearly 90% chance that the Fed will cut interest rates in September, according to the CME Group's FedWatch tool. Brad, back to you.
So perhaps we'll just be paying close attention to the press conference.
As always, yes.
See what that tenor is. All right, Josh, thanks so much. Teeing up this week's activity and what we're set to hear from the Fed. It's a big week for tech companies as Microsoft, Meta, Apple, and Amazon all report their latest earnings. Here to help us talk through all things tech, we've got Bryant Van Cronkite, who is the Allspring Global Investments Senior Portfolio Manager. Great to have you here with us. Okay, so is there one of these tech names that could really kind of be the make or break for the broader earnings season?
Good to be with you today, Brad. I think all of them are incredibly important. There's a tremendous amount of capital that has chased these big AI early winner trades. And right now, investors are worried about two things. They're worried about the slowing of the growth rate, so the second derivative slowing. And they're also worried about the return on investment. Is there going to be enough early return over the next 1, 2, or 3 years to justify these major investments? And investors are listening very carefully for that. I don't think any one name matters at all, but I think those two big themes matter across all those names.
And so the theme that we have seen, at least in earnings seasons past for some of these major tech companies, has been, hey, what the heck are they going to say about generative AI? What do the investments look like? What are the real technological advancements that are going to be put into their customers, whether that be business customers or just consumers who are at their house trying to figure out, okay, what can generative AI do for this recipe that I'm trying to make? All these things considered, that was the theme of earnings season past. What is the theme going forward from here that investors should be paying attention to?
The theme now is how do we make money, right? All these ideas on paper sound great. They sound wonderful. And in theory, they can help drive revenue, help improve margin profiles by reducing costs, but we're not seeing it show up yet. It's time to show me the money when it comes to these AI trades. And my fear as we go up cap is that it's not there. Now, down cap, we're going to start seeing more and more companies begin to talk about that. They're going to start putting real world examples to work here. And I think you might see that AI money move down cap. But the reality is no one's going to be showing you, or very few companies will show you right now that they're actually making money or saving costs in a material way at this point in this AI life cycle.
All right, we love a good Jerry Maguire reference to begin the week, so thank you for that, Brian. You know, as we're thinking further out to some of the broader plays outside of tech that investors perhaps should be keeping close tabs on as well, if there is a rotation, if there is some profit taking that really comes into light right now, where else could that either be put back to work or ultimately investors start to kick the tires on other trades?
Well, I've been calling for this value rotation going back a couple of weeks now, and it's starting to play out, but there could be more legs to this, and it makes a lot of sense. With the amount of money being concentrated in a narrow market, we only get there for one of two reasons. We either get there because of greed or exuberance, which we have today around the AI trade, or you get there out of fear. When you're worried about the overall economy, maybe the Fed being late to react, pushing us into a recession, you want to get more and more capital around a fewer and fewer set of companies where you have the most visibility. So both fear and greed have pushed capital into a narrow market, but those will both get resolved eventually. And I think the cool inflation prints is giving the market the belief the Fed can begin to act, giving them the chance to jump through that ever-closing window to avoid a recession. And as that happens, the natural rotation is out of the concentrated names into the value trade, into the broader markets. That's what we're seeing now. That, I think, will continue, but we need to be aware of what we're buying. You cannot just go out there and buy the lowest quality companies in small cap land, the non-earners. You want to buy companies that are not dependent on a generous Fed, companies that are controlling their own destiny by deploying capital in a wise way, companies that are acting offensively, even if we're going to go into a defensive world.
You know, even as the focus this earnings season, as it is every earnings season, but it seems like more outsized this earnings season, the focus really being about and around net profit margins right now, especially across some of these big tech names who have already talked about the big investments that they're making for their businesses to really spur that next leg of growth. You know, as you're thinking about securitizing some of those margins, where do you expect these big tech companies to be able to lean or pull a lever in order to show investors that they have other areas where they can drum up profit in the face of a consumer that seems battle weary right now, at least?
Yeah, I think anytime you worry about a slowing top line, if we're going to go into a slowing overall economic environment, which is plausible, maybe probable at this point in time, companies need to show other levers. And so one of the best places to show is in your margins. But you're going to have deleveraging as top lines fall because your fixed costs aren't changing materially. So what can we do on the variable cost side? And a lot of that will have to come through labor. And here's where things get a little dicey for the overall market. If companies need to start pulling the lever of reducing labor, unemployment will rise, and that's going to cause concern across the broader market. So my view on this, to answer your question, is they're going to start pulling back on labor, which is going to push unemployment higher, which is going to suggest the Fed has missed their window, and ultimately we're going to push into recession. That's the biggest concern. Now, on the other side of that, labor costs are beginning to come down, so the inflation in labor is dropping. Some of the chemicals, some of the materials, some of the metals are dropping, so some of the cost of goods sold in industrials and materials could be improving. So there's other ways to play that, but the most direct way that companies have, unfortunately, is reducing headcount, which is going to put pretty much a significant concern into the broader markets.
All right, we'd certainly be watching for any kind of concerted announcements around headcount reduction over the course of this earnings season, especially from those tech companies, as we know you will be as well. Bryant Van Cronkite, who is the Allspring Global Investments Senior Portfolio Manager. Great to have you here with us on the show.
Good to see you.
Thanks. Well, McDonald's customers are tightening their belts yet again, the fast food chain falling short of Wall Street's estimates. Now, it aims to double down on its position as a value leader to get consumers back in the door. Yahoo Finance senior reporter Brooke De Palma has been all across the brand of the Golden Arches. Brooke, what do we know here?
McDonald's is really looking to change Americans' perception that it's unaffordable, that it has increased prices too much. It's really looking to double down on that keyword value. In fact, it was mentioned nearly 100 times on a call with the McDonald's investors this morning as the company really waited on that $5 meal deal that they introduced back at the end of Q2 on June 25th. And they indicated why exactly it's doing well. Here are 3 reasons why. It's resonating well with low-income consumers. It's driving incremental incremental sales growth with the average spend of over $10 for that $5 meal deal. So consumers are adding more, perhaps getting multiple of those $5 meal deals. And now we know that 93% of U.S. restaurants have agreed to extend the deal until August. And that's ultimately going to bridge the gap until McDonald's introduces a new, longer-term national value menu platform. And just think, the dollar menu, that ran for 10 years. The $1, $2, $3 menu now is still in place, and that's been around for 6 years now. And so McDonald's really saying that it's time to come out with a new national value menu platform that perhaps has more offerings. They're saying that this one here is a bit too narrow for consumers. They're looking for more here.
And perhaps one that leans a little bit more into rewards. It seems like rewards platforms have really garnered a lot of attention among investors. For McDonald's, though, if we kind of paint a broad stroke on expectations for the remainder of the year, how do they expect to perform here?
Look, here's the deal here. McDonald's is competing with food at home. They're competing with the price of groceries. And so the CEO saying that there is a continued gap between food at home and food away from home, that consumers are being more discretionary still as they approach how they're going to go to restaurants. And they're also seeking more deals when they do go to restaurants. But U.S. President Joe Erlinger really painted a picture here. Take a listen to what he said on the call.
At the end of the day, we expect customers will continue to feel the pinch of the economy and a higher cost of living for at least the next several quarters in this very competitive landscape. So we believe it's critical for us to consider these factors in order to grow market share and return to sustainable guest count-led growth for the brand.
And they're competing with consumers, not just who are going to the grocery store, but also across the fast food landscape. We heard from so many companies like Burger King and KFC and Taco Bell introducing these value meal deal bundles in order to gain not only that lower income cohort, but also all consumers right now who are really thinking twice about where they're spending their money, Brad.
All right, Brooke DePalma, been tracking all things shares MCD here this morning. Thanks so much, Brooke. Appreciate it. Well, more than half of Americans believe the U.S. is currently in a recession, according to a Harris poll. And that's despite the fact that we're actually not in a recession. And to help alleviate the pressure of inflation and higher costs of living, more people are turning to buy now, pay later services. 76% of people believe that buy now, pay later helps them improve their overall financial situation. To discuss what the rise of buy now, pay later services signal about the state of the consumer, Michael Linford, who is the Affirm CFO, here on Yahoo Finance to discuss with us. Michael, great to connect with you once again, and thanks for joining the show here with us.
Thanks for having me.
Certainly. So let's dive into this. I mean, there's a lot of thought that buy now, pay later helps you offset or at least relieve some pressure where there's this existing thought of where inflation is impacting cost of living, where higher rents or even home costs are impacting what you can actually go out and buy in discretionary spend. So what is the real-time calculus that you're seeing households and individuals work through right now that pushes them towards buy now, pay later?
So, look, so long as consumers feel like we're in a recession, it actually doesn't matter if we're in one. Our survey that we recently conducted shows that consumers have a strong sense of unease and uncertainty about the economy right now. And what Affirm offers is a sense of certainty and control in these very uncertain times. It's not surprising, but nearly all consumers cite having predictable expenses as a key part in maintaining their household budgets. And that's what Affirm offers and what credit cards can't. And so we feel like we're really well positioned to help consumers manage their financial outcomes in these very uncertain times.
Michael, I mean, I'm sure you've just heard our conversation around McDonald's and what their struggles are with the consumer. I mean, I doubt people are doing buy now, pay later on their McDonald's fries, but I mean, it seems like we're getting to this point where we're trying to figure out exactly where the consumer is leveraging buy now, pay later the most. What are you seeing from your data?
Yeah, in our last quarter, we grew at a growth rate that was 4 times that of U.S. e-commerce. Consumers are still in the early stages of what we consider to be a secular shift away from credit cards, away from revolving debt with uncertain outcomes, and moving towards certain outcomes we deliver with Affirm. And so I think we're pretty early in that cycle. And so some of the macroeconomic trends aren't necessarily showing up in our category data. All of our categories were growing last quarter except for sporting goods. But what's clear to us is that consumers are looking for more control and more certainty as they look around and see some uncertain times. And it's a feeling more than it is a fact. I mean, you pointed out at the top, the data indicates consumers think that we're in a recession. And, credit to Kyla Scanlon for coining the phrase vibecession. That's where we're at. There's a vibe here, and consumers are trying to be reactive to that. And so predictability and control are really important to them right now. One choice merchants have is to use discounting, as you discussed with some fast food chains. Another approach is to give consumers certainty. It's not surprising that half of consumers say that a 0% financing offer from a company like Affirm will impact their decision to make a purchasing decision. That's because we give consumer certainty. And when they look around the economy right now and they see lots of uncertainty everywhere, and they see somebody providing that certainty, that encourages them to continue to engage.
Michael, while we have you, and I think, you and I talk about this time and time again here, but I think it's more prevalent, even more so, given some of the data that we're rattling off here, and thinking about the near-term relief versus long-term risk for consumers. For buy now, pay later and the impact to consumer credit scores, how are we ensuring that, if people are looking for that near-term relief, that they're not layering on long-term risk and pricing themselves out because of the impact to a credit score later on down the line if they're unable to pay on one of the buy now, pay later purchases that they're making?
Yeah, I think it's really important to think about the buy now, pay later industry in long-term and short-term obligations. In the short-term sense, where the pay in full product is so profitable, there's really little risk in accumulating long-term liabilities just because those things move so quickly. They turn over 17 times a year. But for longer-term obligations, it's true that consumers need to be very aware of these obligations they're taking on. What's important about Affirm, though, is our business model is such that we're so aligned with the consumer. We can't win unless the consumer wins, because we offer consumers immutable uncertainty when they check out. The total obligation is known. They can't revolve. There are no late fees with our product. We can't win unless the consumer is also winning. And so our company is built behind making sure that we can reliably predict and deliver credit outcomes for our consumers, which is really important, for our merchant partners who want us to help them grow their business, and for our capital partners who are investing in the loans.
It's interesting. We were having a conversation with the Conference Board's chief economist who said that this is a consumer that is battle weary. How would you describe the consumer right now?
Yeah, I think the consumer is experiencing a lot of mixed signals. So inflation is cooling, and yet prices remain very high. Real wages have actually kept up really strong over the past 12 months, but unemployment is beginning to tick up. And everybody on shows like this have been talking about a recession now for a very long time. And as the adage goes, economists have predicted 9 of the past 5 recessions. I do think that the consumer is bombarded with all of these mixed messages. And our data suggests that the consumer, more than anything, is just uncertain. And they're looking to somebody like Affirm to provide that certainty.
And just lastly, while we have you here, I mean, when we think about the business itself for Affirm, I know we're in quiet period. We can't get into any financials. We don't want to get anybody in trouble here. But, even as we're thinking about this earnings season and margins as a whole right now, I mean, companies like buy now, pay later, companies like Affirm, how do you guys go about pulling certain levers to ensure investors that the margins are secure, that they can come to expect what this company has been able to show them in its own growth rate over time?
Affirm has done a phenomenal job in pivoting the economics of the business into this current macro environment. The past 12 years, in my opinion, has been a clinic on how to manage the macroeconomic risk in the business and create really strong units. We did that through really strong control of credit outcomes. We did that through pricing initiatives with merchants and consumers. And if you look at last quarter, we posted extremely strong unit economics and an incredible amount of operating leverage. And we feel like we're going to continue to do that from here on out.
All right, Michael Linford, Affirm CFO. Michael, always a pleasure to grab some time with you. Appreciate it.
Thank you.
Certainly. Everyone, we've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, we all know the healthcare industry is extremely complicated, and if you've ever had to advocate for yourself with an insurer, a provider, or a pharmacy, then you know just how disconnected and confusing and discombobulating it can all be. So, Yahoo Finance Senior Health reporter Anjali Kamlani is here to break down some of the intricacies of the industry. So, Anj, let's start with different parts of the healthcare industry. Just tell us how it works and how it affects our wallets at the end of the day.
Yeah, we all know it's complicated, but I can't promise I'm going to make it uncomplicated, but I'm going to explain to you why the infighting that consistently and constantly happens is affecting you. So let's take a look at what the different parts are that I'm going to talk about. First of all, you have to think about the way that everyone is being paid within the industry. You've got the health providers and tech service providers like your telehealth and the like. They are being paid by insurers. Then you've got the pharmacies. Now, they're technically being paid by insurers as well because the pharmacy benefit managers sit underneath them, and those are the entities that negotiate with the pharma company. So those are the drug companies, and the money is being exchanged back and forth. So I'll give you the health service providers because I think that's the most popular sort of interaction that you as a consumer would have with the industry. Health providers constantly negotiate with insurers in order to get paid. So when a health provider, especially those who are publicly traded, we see when they have strong quarters, what that means is they got more of your money, either through directly out of pocket for you or through the insurer. That means their reimbursements were higher, they were able to negotiate better with the insurers, they saw more patients or more volume so they could charge more, and more volume means more procedures done. So while that does come with a cost and expense to them, they were able to cover their costs with the money that came into their pockets. And why that's important to understand is because it's not as simple as you go to the doctor, get a visit, a claim gets submitted, and then they get reimbursed. It's actually an ongoing negotiation despite the fact that insurers already have a negotiated rates set with these providers. They still continue that negotiation process. So let's look at the insurers and how they make money off of you. If you think about insurance companies, you pay a premium every month. Well, that premium goes towards covering costs and is part of a pooled set of money that goes towards costs and claims. Now, when an insurer has a strong quarter, and we know they've been having those, that means they kept more of your money. And because there are these vertically integrated, really broad companies now, that money also gets shifted inside of it. Now, they pay fewer claims. That means they have more money. They kept it on the books for longer. The days of payment claims is also there. And also, if fewer members utilize the health system, the health services, that also is good for them because it means they kept more of your money. And all of this is just to tell you that that is not necessarily the best use of the money. And they have a specific number that they're supposed to pay out every single month. And if they don't meet that, then they're technically supposed to give it back to you. But because there are these complex systems right now, they're able to move it around internally and keep that money inside. So take, for example, some of the biggest insurers are also service providers, or they're also PBMs, so they're dealing with your prescriptions as well. All of that goes into the flow. Meanwhile, pharmacies are battling it out with the PBMs. They're constantly negotiating the same way the health service providers are with the insurance companies. The pharmacies are doing the same thing. They're constantly having to negotiate for these drugs and the payment that they get for them. In some instances, if you get a prescription filled, that pharmacy could get a negative reimbursement in the sense that it costs them more to fill your prescription than the money that they're getting in for it. So they're working at a loss sometimes.
And we've got some big healthcare companies that are, of course, reporting over the course of this week. And it's going to be interesting where, as they continue to really look across the consumer set right now, how many consumers are opting in, continuing to be able to pay certain healthcare procedures or healthcare services, and where that's also impacting their wallet or their pocketbook at the end of the day because of the costs that the health insurers are pushing down to them as well for servicing. All right, I think I got it all there, Anjali. Thanks so much for breaking this down. Appreciate it here. Everyone, we've got much more wealth after the break. You're watching Yahoo Finance. The outstanding federal loan balance is over $1.6 trillion and accounts for over 91% of student loan debt. That's according to the Education Data Initiative. So once you get into the student debt hole, it takes a while to get out, but there might be some tax-advantaged ways for people to pay for their loved ones' college tuitions. To discuss, let's bring in Jerry Boyle, who is the BNY Wealth, Tax, and Estate Planning Strategist here with us. Jerry, great to see you here with us today. All right, so what do people need to know about some of the tax advantages that, you know, they might just need to give a phone call to a loved one or phone a friend if they're looking to pay down some of this debt?
Well, as far as paying down the debt goes, I think the planning that you have to do is what you have to do before you actually go to school. For example, a lot of people should be thinking about doing 529 accounts, open up accounts now, putting money into the accounts to save for college. When the disbursements are made from the 529 plan to pay for tuition, et cetera, that's a tax-free distribution. So that's one thing a lot of people should be looking at right now. The other thing people should be looking at is also if they have a relative that has a substantial amount of wealth, that relative can make a direct payment of tuition to the college or the university, and that is a tax-free gift. And a lot of people overlook the fact that somebody can make a tax-free gift in the amount of tuition. And the key there is obviously that it's going to be made directly to the educational institution. If you made it to the student and the student paid the tuition bill, that does not count for the gift tax exclusion. But that's something that's frequently overlooked by people.
If it is then given to the student, then the student goes and pays. Who is taxed there? Is it the gift giver or is it the student receiving the gift?
It would be the gift giver. The donor would have to pay that. That would be deemed to be a gift from the donor to the student. And so it wouldn't be tax-free. Now, you do have exclusions from gift tax, and the exclusion is quite large right now. Right now, it's $13,610,000, so it may not be a big deal for a lot of people. But people ought to take advantage of the fact that if you follow the rules, you can make a direct transfer to the university for somebody's tuition, and that's gift tax free.
And so if you are making that direct transfer to a university on behalf of a student, what is the criteria? What's the data that you need to hold on to? And not data, but the perhaps paperwork or receipts that you need to have once you're filing that gift as well?
Well, what somebody would have to do if they did do that transfer to the university, you'd probably want to keep your checks to show that the check was actually paid directly to the university as opposed to being paid to the student and the student churning around and sending the check to the university. So I think the most important thing is to have some type of evidence that shows that the payment was made direct. And if it's made by check, obviously, if it's made out to XYZ university, that would be enough substantiation. Otherwise, some electronic transfer from a bank account if you kept your bank statements. You just have to have some proof that it was made directly to the college or the university.
How many people are actively doing this right now, from what we can estimate at least, Jerry? And is it expected to grow, the number of gifts being made directly to universities on students' behalf, considering the rising costs or the high price of tuition right now?
I think that most people that are taking advantage of this provision of the tax law are wealthier people because most people just can't part with that amount of money. You know, if somebody's going to school, for example, in Boston, where I am, where the tuitions are about $90,000 a year, that's a lot of money to transfer directly to a university. So for the most part, this provision is for pretty much wealthy people, not for the the regular person that's going to school, blue collar type of family.
Jerry Doyle, who is the BNY Wealth, Tax, and Estate Planning Strategist. Jerry, great to see you as always.
Thank you.
Thanks. We've got much more on wealth after the break, everyone. You're watching Yahoo Finance. Financial opportunities, whether through NIL or other brand deals, are becoming available for student athletes at younger and younger ages. That's why IMG Academy, the world's leading sports education brand and one of the top athletic high schools in the country, is partnering with Merrill Wealth Management to build a financial education curriculum to help prep young student athletes for the opportunities coming their way in the future. For more, we welcome in Greg McGauley, who is the Bank of America head of Merrill Private Wealth Management, and Brent Richard, who is the IMG Academy CEO. It's great to have both of you here with us. First, Greg, I'll just start with you. What made this partnership make sense, and what can students expect?
Well, Merrill and IMG Academy, announced this 3-year partnership to offer more education and resources around financial awareness to student athletes and their families. We've been serving clients in the sports industry, players, owners, coaches, and agents for a long time. And a few years ago, Merrill created a dedicated sports and entertainment group of advisors who have experience providing strategies for our clients. This program is going to allow us to provide a great amount of financial education to the students at a young age in order to help them better prepare for life in general.
Brent, first, congratulations to some of the success that you've seen over at IMG Academy. I was taking a look at, of course, this most recent NBA draft that kind of cemented a 10-year status of IMG Academy, seeing at least 2 alumni selected in the NBA draft 7 times, including 2014, 2015, 2020, 2021, 2022, 23, and 24 here. I mean, this is kind of an incredible track record that you're really lining up here, but it comes back to not just sports preparedness, but financial preparedness too. What do you want the students to take away from their experience off the court or off the pitch or the mound or wherever, in whichever sport they may be competing?
Yeah, sure. Well, thanks for having me, first of all. And it has been incredible success at IMG Academy. One of the more interesting stats is actually that we send as many student athletes every year to the Ivy Leagues as we do the professional leagues. And so on one hand, we have 15 current or former student athletes that are currently in the Olympics. On the other hand, we had almost 30 student athletes last year that went to top 25 U.S. News ranked academic schools. So, for all of our products, both on campus and online, we have camps, boarding school, online recruiting and coaching. We share one purpose, which is to empower student athletes to win their future. We say preparing them for college and for life. We believe sports is a platform for life. We believe sports is a platform for education. We are incredibly intentional about teaching life skills. We have staff on this campus that all they do is teach resilience the same way that we teach algebra. So I think this is what sets us apart in a lot of ways, this combination of sports and school and life skills. And it's just very obvious, especially in this moment, that the next frontier of building this base of life skills is financial education. It is a critical life skill. It always has been a critical life skill. I would say in this moment, it's very relevant to today's student athletes. There's more financial opportunity coming sooner than it ever has before to student athletes all around the country, and we have to be great in this area. And I think with Merrill, we think that we can be.
And part of one of the reasons, at least for that financial opportunity and wealth building coming earlier, is really kind of pegged to NIL, name, image, and likeness deals that young athletes are seeing if they have a large following or if they go to the right school and are able to use that as a platform as well. Keeping a pulse on the athletes, the student athletes at your school. What is the talk around the hallways or, even on the campuses around students and how they're being approached and the brands that they want to work with as well as you're evaluating what opportunities are right for them and trying to coach them financially as well, Brent?
So most of the conversation has been really around that path to college and the opportunity in college. And it used to be tuition and books, which was a tremendous financial opportunity for student athletes. And today, it's not only tuition and books, it is now not only name, image, likeness, but as you've seen recently, the Power Four and some of the settlements going on, potentially moving into revenue sharing as well. And so there are a lot of questions from families. We are getting pulled into these conversations from families asking, what does this mean in my college decision process? And when financial opportunity comes, how do I think about it? How do I manage it? How do I attach myself to the right brands? And as we say at IMG Academy, it's we work on both sides of that equation. The first question is, who am I? So we have character development as a core part of our curriculum. You have to say, who am I, before you can say, what brand do I want to attach myself to? And only after that do you get to start to talk about, well, what do I do with the income that I'm now getting as a result of name, image, likeness, revenue share, or some of these other opportunities that are coming sooner and sooner to student athletes.
Greg, I wonder from your perspective on the wealth management side, are there pitfalls that you've seen, at least in the early innings, especially compared to where we are on the broader scale of some of these deals coming about for student athletes? Some of the pitfalls that you've seen in the past that students can avoid at this juncture?
Yeah, I think that the idea of the financial education starting in an early age prevents a lot of those pitfalls from happening. But more specifically, it's like understanding, that financial decisions have an impact on your bottom line. So the decisions that they make early are going to impact their future in a major way. I also think that, understanding how they're going to get compensated and the full impact of taxes can lead to a better understanding of how to manage cash flow. Things like not developing a budget and staying within that budget and living to a lifestyle that you're able to continue to save money for the present and the future helps as well. And then, protecting their information, even from things like cyber threats, help them preserve their wealth and not have it deteriorated or taken from them very, very quickly. And then really around, understanding at an early age different investment options. We've all seen athletes and even young adults get involved in things that they necessarily shouldn't from an investment standpoint. And so having investments that match their goals and objectives are really important even at a young age.
Just lastly, while we have you here, Brent, I'm looking across IMG Academy and the success that we talked about at the start of this. How far are we from looking at IMG Academy as a type of program that has different locations? Primarily in Florida right now, but are we going to be looking at IMG Academy East or IMG South or IMG West at some point? What's the expansion look like?
We are always evaluating. What I'd say is what we've done over the last 4 or 5 years is we've added sports. We added women's volleyball. We just announced we've added girls women's softball as well. So we've added sports onto our Bradenton campus. And really importantly for us, we are trying to make our programming available to any family that believes in sports as a platform for life. So we have over 100,000 online customers now working with us in our online recruiting product called NCSA. We have online mental performance coaches, online nutrition coaches, and hopefully here pretty soon online financial education coaches as well. So we are trying to make it easier and easier if you're a family anywhere in the world to access IMG Academy education.
All right, I wasn't good enough. I wouldn't have made the cut, but I love to see the student athletes really performing at such a level that really sets them up for success in the future, and a partnership like this that helps them get a little bit more financially minded ahead of time as well and add on to the skill sets that they already have. Greg McGauley, who is the Bank of America head of Merrill Private Wealth Management, and Brent Richard, IMG Academy CEO. Thank you both so much for taking the time. Appreciate it. We've got much more wealth on the other side of this short break. You're watching Yahoo Finance. Athletes are convening from around the world, and they began to take the world stage this weekend for the 2024 Summer Olympic Games in Paris, France. But while they seek glory and hopefully some riches, the city is left to foot the bill. The latest estimates put the Paris Games, at 8.9 billion euros, or about 9.7 billion US dollars is the budget there. Now, this broke the original budget from when the city bid about 7 years ago, but is one of the least expensive recent Summer Games. London 2022 clocked in at $16.8 billion. Rio was $23.6 billion, and Tokyo in 2020/2021 with $13.7 billion, according to the Oxford Olympics study. So, is it worth it to the city and the people who live there to host the Olympic Games? Joining me now is Andrew Zimbalist, who is the Smith College Professor of Economics here. Great to have you. So, is it worth it when you consider all of the costs that cities have to take into account to host the Olympics?
Simple answer is no. And let me also point out, Oxford has done some wonderful work on the Olympics, but their budget numbers are including athletic infrastructure. They're not including transportation infrastructure, telecommunications, or hospitality infrastructure. So it doesn't represent the actual cost. So Tokyo is probably somewhere the actual cost, in part because of the delay from the COVID pandemic, their cost was probably over $30 billion. Rio's cost was probably over $20 billion. In Paris, yes, $9.7 billion is now the number they're using. But does it include the cost to clean up the Seine? Does it include the cost of the metro that goes to the Saint-Denis area? Does it include the social and business disruptions that are happening during the weeks of the Olympic? Does it include maintaining and operating the facilities that have been built or modernized for the Olympic Games? There are a lot of things that are not being included. Those numbers are fungible numbers, and you just have to take them with a large grain of salt. Look, at the end of the day, what do you get from hosting the Olympics? You get maybe $5 billion for Paris. That's some of the international, about 20% of international television revenue. It's some of the international sponsorship revenue. It's some domestic sponsorship revenue. It's the ticket money. Add it all up, it's about $5 billion. So if you spend $5 billion, if you receive $5 billion on one end, and you're putting out minimally $9.7 billion, but probably a lot more than that, then of course the economic calculus is not very good at all. And there have been other disruptions. We heard about the train sabotage that has probably cost hundreds of millions of dollars. So you have to look at this very, very carefully. It's not, generally speaking, a good economic bet.
Okay, and so what do you think the IOC needs to take into consideration to better evaluate the economic cost that cities are taking on, essentially, when they decide and put their bid in to host the Olympics?
Well, the IOC, as I just said, they give about 20% of the international television money. That's the biggest chunk of money that comes in, 20% to the host city. So they could look at giving the host city, they used to give the host city 50%, and even higher than that, going way back to the 1960s. They give them a higher percent of that money. Now, the IOC, it's not a for-profit organization. They take the money that they earn. Of course, they take care of their executives very nicely, but the vast bulk of their money is going to international sports federations and national Olympic committees. So I think, at the end of the day, what we have to do is look at a rationalization of the Olympics, an altogether rationalization. What would be rational? It'd be rational not to look to a new city every 4 years to rebuild the Olympic Shangri-La. In my view, the best thing to do would be to have one permanent host for the Winter Games and one permanent host for the Summer Games.
Okay, and just lastly, while we have you here, is the cost for the Olympics, is it going to be continuing to just kind of go on this upward trajectory? What needs to be changed ultimately to make it more affordable for the cities that are hosting it?
Well, I think I just told you that. But look, to its credit, the IOC has made changes. The problem the IOC has faced over the last 15 years is that nobody wants to bid anymore. So they put the whole bidding process behind closed doors. We can't even see it. But they have made some changes. They have simplified and made more flexible the demands that they put on the host city. And that saves the host city a couple of $1 billion, which is nice. But if you're spending $20 and $30 billion, you save a couple of billion, you're still in a large deficit.
All right. Andrew Zimbalist, who is the Smith College Professor of Economics. Thanks so much for taking the time today.
My pleasure.
Well, the travel industry is in the midst of another busy summer. The price for airfare, hotels, and rental cars is certainly adding up. Travelers looking to save money on their next vacation might find that budget-friendly destinations are a great option. And for more on how to save money and make the most out of your next getaway, we've got Kristen Taylor, who is the Vacasa Vice President. Great to have you here with us. And so let's talk about some of these more affordable travel destinations and where consumers are opting into those experiences versus perhaps some of the more pricey ones out there. What are you seeing based on some of the booking data?
Yeah, I mean, we're definitely seeing over half of Americans want to travel this summer. They want to take a vacation. The majority of them do want to travel domestically, stay within the US, mostly for that savings. Short-term rentals, vacation homes hit all the marks for that. You can get a group of individuals together, family, friends, chip in and save quite a bit of money. You've got amazing destinations. Specifically, there's a lot of beachfront locations, lakefront, waterfront locations where people are able to rent homes for around $250 a night, which is a really great deal.
And so with that considered, how is this changing the average cost that we're seeing people be comfortable with spending on vacations right now?
Yeah, I mean, we're definitely seeing people wanting to save as much money as possible. So with the short-term rental, your savings really comes with the chipping in individually on a shared home. You save a lot of money with being able to eat in, grocery shop, have a vacation without necessarily needing to go out and spend a lot of additional money on amenities, transportation, food and beverage, things like that. You can really enjoy a great vacation with your loved ones and save as much money as possible by not needing to spend a lot of money on those additional things. You can have a pretty low budget vacation right at a beautiful beach or a lakefront and not have to worry about, breaking the budget.
And so does that change the calculus for people who are looking at certain international travel destinations? Let's say Paris, there's a last minute trip and they want to just go to take in the Olympics. I mean, is this dampening demand for the amount of people that would go and be able to take in the Olympics?
No, not necessarily. I mean, I think there is a time and a place for all kinds of different travelers. Labor Day weekend, typically, we're gearing up for kids to go back to school. We're looking at people that are trying to get out and enjoy the last minute joys of summertime. So I think that demand is definitely shifted a little bit more towards those drive-to markets where people can last minute book something. They can get in the car, they can drive 2 hours away and experience some really great locations. We're seeing a huge demand for coastal Maryland, about $236 a night. That's one of our biggest search destinations on Vacasa.com for Labor Day weekend. West Florida Panhandle, around $219. Destin, Florida, which you get the beautiful white beaches for about $183. So we're not necessarily, feeling like we're competing with international travel, but we're certainly opening up the availability for people that maybe just want to get out of town. They don't have a ton of exorbitant money to spend to go internationally to the Olympic Games, but they can certainly still enjoy a great last minute summer vacation with their families.
All right, a destination with a good TV so you can still watch the Olympics is at least the bucket that I'm in. Kristen Taylor, who is the Vacasa Vice President, thanks so much for taking the time here.
Thank you very much.
Hey, let's do a final check of the markets here as we're taking a look at the major averages. Right now, the Dow is the lone laggard, but it's flat. We'll see if it can trickle into positive territory here. That's at least where things started on the day. The S&P 500, you're seeing that hold on to gains, up by about 0.25%. The Nasdaq Composite, that's up, holding on to gains of 0.3% here. Big week for economic data. You've got a lot of focus on the employment situation and the jobs front with the ADP private payrolls coming out later this week. And of course, that all-important monthly jobs figure. Plus, you've got the Fed and you've also got some big earnings coming your way in the tech space. That's it for Wealth. I'm Brad Smith. Thanks so much for watching. Hey, stay tuned. Market Domination with Julie Hyman and Josh Lipton. I know them. Coming up 3 p.m. Eastern Time. You do not want to miss it. Trust me.